Hey guys, my name is Sage, and today I'm going to be teaching you how to trade futures. So there's a school of thought that we're going to combine here. If you've ever traded shares or ever traded options, you're going to combine both of the methodologies. I'm going to explain this a little bit further. Shares have always been capital intensive, right? You need a lot of money to generate not so much money. 10% return on $100,000, there you go. I mean, the only benefit to buying shares, I think, is if you catch a nice little rally and buy dips, then you're not as susceptible to the short-term capital gains tax that you would have as a short-term trader. Now, with options are the best leverage vehicle that have ever been invented, literally. If you catch the right moves and you do it 3, 4, 5 times over, you can make $1 million. It's totally possible to do. You don't need $100,000. You can start off with $1,000. I digress. Now, futures are going to be met somewhere in the middle. Futures do provide leverage. It's not the same thing as options, not even close, but you don't need all that capital. Futures have been around forever. It's not an NFT situation where, it's here today, gone tomorrow. They literally have been around just as long as options. Now, the way that I'm going to teach you, we're going to have timestamps for everything, but the way that I'm going to teach you is I would prefer that you follow all of the videos sequentially if it's going to be more than one. I would also prefer that if I'm going to teach you how to set an OCO order or use a bracket order or use some sort of technical analysis, use my trading system, but use it as a template and then modify it, retrofit it to your psychology and how it is that you trade, right? I've given up on copying someone exactly verbatim and trying to have exactly same results. It just doesn't work that way. If you are taught how to trade and look at specific things, then you can determine the risk reward and you can see what is going to be better for you. That's what I'm going to do, and that's my goal for the futures trading video. These are going to be longer videos, and as I've just stated, it will be timestamped. Once again, I would prefer that you not gloss over anything, right? I would prefer that you go sequentially so you can build on top of one thought process over another so we can build upon the climax here that you're going to see what the trading system is all about. So let's dive into the first slide. The first slide is going to be Guide to Trading Futures Successfully. You're going to understand the tick system, how it is that you make money and how much risk that you're incurring. I have already included a sheet, which I will explain here in this video as well, of what the point system is, what a tick is, how much money that you are putting on per risk, and how much margin that you need intraday, or if you're going to hold a position if you decide to swing it. Next is going to be choosing a competent broker. This is the only aspect of the trading where you need to decide what's going to be best for you. I use Tasty Trade. Now, Tasty Trade is not the best broker for futures, but it's what I have for right now. Maybe in a couple months, I will go into NinjaTrader and then I'm going to start doing my things there. So NinjaTrader, I think right now is the cream of the crop when it comes to futures trading. TradeOvate is pretty good as well. TOS is tried and true. It's going to be best all around where you can do options buying, option selling, shares. You can do a whole bunch of things that, NinjaTrader can do as well. NinjaTrader seems like it has superior backtesting overall, and it seems like the fills are relatively quicker. So of course, yeah, NinjaTrader seems like it does take the cream of the crop right now. So choosing the competent broker or one that's best for you, if you're an international person, because I know there's a lot of international people here as well, IBKR seems like their UI is not the best, but in terms of fills and in terms of their overall system capabilities, I think it's a very, very good choice. Next is going to be knowing your margin requirements. How much money you got to have in your futures account? Are you going to open up a new futures account? Or are you going to trade off that, right? We're going to be talking about those things. Remember what I said when we're trading shares and then when we're trading options. You have to have some sort of requirement. You can buy shares with leverage, right? I don't always recommend doing that, but it's possible. With options, not so much because it's already, at max capacity when it comes to leverage. Now with futures, yeah, you can leverage this. It's already inherently leveraged, but overall, what we want you to know is just how much money you need in your broker in order for you to take the positions that we're going to be teaching how to take. Next is going to be probably what you're here for, using technical analysis, like what indicators and what system, what am I using? I'm going to tell you right now, I'm not even 5 minutes into this video. There is no magic indicator. The only thing that's magical about trading, the only thing is that if you apply the right risk reward principles, that's it. That's all you need. You need to fire on the same triggers. I'm going to explain this more in depth when we get to the technical analysis section. But it's about identifying where am I going to take this long or short every time and then go from there. And then from there, it's months and years of experience of you deciding what actually is the best risk reward principles for you to fire triggers on. If you're spending all your time on the 30-second time frame chart there, you're going to get a lot of signals. Now, if you zoom out of the time frames, then you're not going to get as many, but you're going to get higher quality signals. And I'm going to talk more about that when we get to the fundamental analysis section. So there's technical analysis and fundamental analysis. We're not going to be looking at data sheets. We're not going to be looking at it's SPY and QQQ and RTY. And then we're going to be talking about the Dow as well. There's not really much to look for there. It's the indexes. We're not trading futures on individual stocks. Futures are basically just the indexes and just commodities. So we'll break that down here in just a sec. Next is going to be developing a trading strategy. I'm not going to sit here and say, copy what it is that I'm doing, and then you're going to have the same exact results that I have. You're going to get very similar, and I'm here to shorten the learning curve for you as much as I can. But that doesn't mean that you have to copy every single little detail if it doesn't make sense to you. The whole purpose of you trading or learning from someone else is taking the bits and pieces that make sense to you and then building your own trading system and then back testing that as much as humanly possible. If you're not back testing, if you're not reverse engineering, if you're not reviewing your trades every single day, literally every single day, then everything that I'm going to teach you is just going to be a waste of your time. I don't want to do that. So with the videos, we're going to be talking about those 3 things that I would say will make you an infinitely better trader. If you are reviewing your trades, if you are reverse engineering things that work, that don't work, and if you are back testing, I think that you have a successful formula for you to be trading futures and add that to your overall arsenal. Cool? So we just went over guides to trading futures successfully. Let's go here to the next slide. We're going to talk about this breakdown. We're going to talk about how to build a watch list. I'll give you an example of a trade that I took recently. I caught, I think, 220 points on it. And I'm going to break down the mechanics. So it's just one example. I'm going to give you a whole bunch. I'm going to jump into my broker and I'm going to tell you how it is that you would set a trade and how you can build a template on that trading system so you have less decisions to make overall. Trading futures is all about eliminating the decision-making process. So it's literally 1, 2, not even 1, 2. It's just 1, get in, get out, hit the stop loss, and then move on, right? And then from there, you track all your trades and see what it is that you need to do to improve. That is what successful futures trading is going to be all about. Talk about the contract value. Most of you are not going to be trading ES, NQ, RTY, or YM. Why? Because these are known as the minis. The minis are going to be a substantial amount of intraday margin requirement and overnight requirement. It's more than that. I don't think it's necessarily double, but it's a large margin requirement because you never know overnight if you're going to have these giant moves, right? It happens all the time. It just happened recently. So for intraday, if you do want to have it on your watch list, which I have it on mine, it's just going to monitor. ES is the same thing as MES. The only difference, right, on the chart, they're the same thing, but the only difference is when you go into your broker and you type MES, I will share with you the examples. You got to see exactly how much money you're willing to make, willing to lose. Definitely, you're going to know the difference. If you have your watch list already in place, you can do this fairly quickly. If you're going to be trading the same vehicle all the time, if you're just going to be trading ES or NQ, or the equivalent, which would be the micros, that's fine. You can just have those too, but have more things on your watch list. You don't just want to be watching, you want to be watching market structure. So the ones that are highlighted in green, check out the tick size and then check out the point system, how they work. There's going to be 4 ticks to every point. You got to understand that math because for every tick movement that you see, right, that 0.25 movement is going to be a movement in how much money you're making. So when you're doing the micros, that's a 2-point move on MNQ. That's a 5-point move right there on MES. When you're doing the big boys, you know, sometimes when you see people, I made $400, $500, $1,000, $4,000 on ES. The reason why is just because the value of each point that's being moved, if it moves 10 points, 20 points, 30, 50 points, then you multiply that by how many points you move times $50. This is where you start seeing, you know, larger futures traders doing their thing. We're not going to recommend that you trade ES, NQ, RTY, and YM. First of all, most of you don't have that sort of intraday margin, right? Some of you are trading with less than $5,000, which is perfectly fine. But you're not going to be able to set that order on these that are not highlighted green. Stick to the micros. Even the bigger player, even myself, I'm sticking to the micros because I have the ability to scale out of the position. Yes, I do have to pay more in fees, of course, but I'm not going to have the ability to take 3 contracts on ES, put down $60,000 and then go from there. I have the ability to do that, but most of you don't. So stick with the micros, okay? If you are a bigger player and you're saying, Sage, I have more than $25,000 in my account, that's okay. But you're going to see, working with the numbers, that you do not want to be taking large positions because every single time you get hit on your stop loss, that's $500 hit, $500 hit, $1,000 hit, $1,000 hit. If you're taking 7 trades in a row and you lost all 7 of them in a row because you're not following technicals, or maybe you just had a bad run for the day, you're down $7,000 now. Cool? We don't want to do that. We want to make this as much about the risk reward than anything else. That is the whole entire point of you trading futures. It's not about you hitting the stop loss and having a 90% win rate because now you're trading a different system. It's not about that. It's about when you take the loss, it's a relatively small loss. It's 0.01% of your overall portfolio. But when you do make a gain, it's 0.5% of your portfolio, or maybe even 1% of your portfolio, because the risk reward is going to make sense when we jump into the broker and when we talk about the trading methodology and the trading system. Next is going to be commodities futures. What do we have? Crude oil, gold, we have natural gas. So just check out the margin requirements for these as well. I've taken the liberty to include that. I would say that all of this should be on your watch list, not because you're going to be trading them, but just so you know where gold is, just so you know where natural gas is. The better you get with this, because hopefully you guys are going to be trading futures for a long period of time, just like myself. I've always known of futures. I've even traded futures in the past, but right now, from where we're at, I understand the value of doing this kind of system where I'm giving up a lot of the potential move that you have leverage with options, just so I can have a little bit more consistency and a little bit more control of what I'm doing with my day trading. And I don't have to worry so much about 0DT, 1DT, 3DT, because with options contracts, if you guys don't already know this, if you're a novice trader and you're starting to learn about implied volatility and the option Greeks, And it's quite a bit that you need to manage, especially if something goes egregiously negative against your bias, right? If that happens, you can go negative 70, 80% very quickly with options. With futures, you have more control over that. All right. So I've taken that liberty to also include the micro contracts. If you decide to trade oil, if you decide to trade gold, or if you decide to trade natural gas, you have the intraday margin. It's significantly less than what we have here. And you also have the tick system. Like, with each point that is moved, then you see exactly how much money you can make or how much money you can lose based on what vehicle that you decide to take. These are some practical examples. So when you're moving 2 to 4 points, this is how much money you can make. Remember, 1 point for every move on ES is $50. So 2 points is going to be $100 and 4 points is going to be $200. For you guys, again, I want to reiterate this point and make sure that I'm educating you guys correctly on this. Be careful with trading ES or NQ. Check out the same point system that you're using. Just check out how much money you can make or lose. This is why we're recommending that you start out with the micros before you start jumping into the minis. Most of you are going to be trading micros for the rest of your career because you want to always keep it nice and small. Even if you're trading with $100,000, $200,000, it's okay for you to do 5, 10 contracts because you can scale out of the position. You're not going to be able to take 10 ES contracts, even though you might be a bigger player. You might be trading with $1 million, but it's just way too much of the margin requirement that you need. This is for 5 contracts. So imagine you do that with 10. You really want to be allocating $120,000 per position. If you get stopped out, even on a good risk reward on that stop out, you take 3 losses, now all of a sudden you're down 15, 25 grand. You don't want that. You definitely don't want that. All right, so next. Oops, sorry. Those are my tongue twisters, my bad. Next is going to be the common scalping profit targets. So when you're looking for a small scalp, right, just take the equivalence here. When you're looking at just getting into position in and out, 10 points is reasonable. I'm generally looking for medium to larger scalps. So on ES, that equates to 15 to 20 points. Larger scalp is anything above 20, 25 points. On NQ, same thing. NQ and MNQ are the same thing, right? Notice that the points, they don't change. The only thing that changes is that intraday margin and how much money you're putting up to win or lose. So anywhere between 30 to 50 points is a good move. It's definitely a good move. So if you're taking just one contract, that's $40 that you're looking to make. Now, if you take 2, 3, 4, 5 contracts, then of course you're going to multiply that out. And then you're going to scale out of the position as soon as you start hitting your profit targets. That's how that works. Okay. You need to know this inside and out. You need to spend some time and rewatch this video, or maybe make your own table. You guys can go into Claude AI. You guys can go to ChatGPT and make an own table for your watch list on the points that you want to monitor. Because if you don't understand this inside and out, then there's no point for you to start putting on positions and start firing because you don't understand what risks that you are putting on the trading floor. Got to understand the point system. Next, I got a few trading notes here. Buying power efficiency. Hopefully I've done a good job in convincing you that the buying power requirement here is not that egregious. You need $2,000, maybe $3,000 for you to start trading. MNQ is going to be probably your weapon of choice. MES is also a very, very good candidate if you want to trade RTY, if you want to trade the Dow. Those are going to be also very good choices. So a couple things here. Ticks versus points. We already talked about this. Tick is going to be the smallest increment that you move. You're going to see on an example that I'm going to give you. It's not in 1 point increments, right? This is very similar to how the currency market works. Everything is tick based, or what they use there is pips. Next is going to be volatility impact. The volatility impact for options, if you're on the right side of the trade, it can be tremendously beneficial. Same thing here with futures, right? You can catch a lot of that volatility, but you won't be susceptible to the option Greeks. Couple of other considerations here. 2 to 1 risk reward is what we're generally going to recommend. I'm going to teach you that way. If you incur large losses, and like, let's say you DM me or you send me a message in the chat and you say, hey, Sage, I lost $25,000. And then I'm going to ask you, what is your risk reward parameter? Are you setting your OCO orders? Were you trading with a stop loss? Were you putting in these parameters? And you answer no to all of those things, then you're not following along with what I'm teaching you. Follow the methodology, right? Follow the guidelines, just like driving. When you drive a car, right? You have all these rules and you have all these things. If you follow those guidelines, you're going to be perfectly fine. I haven't been in a car accident in 15 years, right? I'm a safe driver. It's the same thing here. If you're driving within the guidelines, you're going to be perfectly fine. Putting on your seatbelt, using your turn signals, all that stuff. Now, if you deviate from that, that's where you could run into trouble. That's where you can get into an accident, kill yourself or kill someone else, God forbid. So stick with the 2 to 1 risk reward and stick with the OCO orders. You're going to see exactly how I set OCO orders in my broker. It's going to be the same thought process in any other broker, independent of which one you choose to use. Next is going to be 3 to 5 trades a day. The reason why I include this here, if you're taking 25 trades and you can't make it work, then remember that you're susceptible to something called slippage. When I was learning how to trade, slippage was the biggest deal because every contract that we took or every position we took was anywhere between $5 to $12, $12.95 at one point. So we don't have that same problem. Now getting into shares doesn't cost anything, right? It's a zero cost basis. Robinhood was the first to introduce that, I think in 2015, 2016. Now with options or with futures, it's about $1 to get in and out. But remember, you're taking 35 trades. And if you're losing on 35 trades or you're coming out at a zero sum gain, if you're making $50 on 35 trades, how many How many contracts and how many fees did you rack up on getting into positions 35 times in a day with 3 contracts each? Think about those things. If you are incurring $100 in fees per day and you're only making $150, why are you even doing this? Keep it to 3 to 5 trades. I'm going to teach you that you probably don't get more than 3 or even 5 signals throughout the day if you're doing this correctly. This is the technical analysis side of this. And hopefully I'm going to do a good enough job in conveying that there's really not all that many signals that you want to take in the first place. Then lastly is going to be creating a watch list. I have done this for you. So my watch list is as follows. If you would like to include the volatility indexes, I would recommend that you do that because that's part of my technical analysis in my trading system. So the VIX is going to be at the top. Then ES, NQ, YM, RTY, CL, NG. You guys can read it going forward here. So I've also included MES, MNQ. They're the same thing. They're the same thing. So I'm using the NQ chart, and then in my broker, I'm going into MES or MNQ. Don't mix that up, right? For most of you, if you have the buying power, in order for you to get into some of these larger positions, pay attention to what you're doing. Pay attention to, okay, Sage is telling me I'm using NQ or I'm using ES, but he's also telling me trade micros. Don't trade the minis, because if I do that, if I have the buying power and I'm not paying attention to the bracket orders that I'm putting in, I can screw myself over. So I'm going to be paying attention to him because he doesn't want that to happen to us. And that's entirely true. So this is what an OCO order looks like. I'm going to explain the methodology and why I have this maybe a little bit differently than what you've anticipated. So in this situation, NQ was trading at 0.7375. So that's that tick system, right? It's not just the 1 point, but it's actually going in. You have 4 ticks within each point. There you see that. The closed profit. If you look at the closed profit versus the loss that I'm looking to incur, just simple arithmetic will tell you this is a substantial risk reward calculator. It's absolutely phenomenal. So if I'm looking at this is an 8-to-1 risk reward. It's close to that. Why am I setting it there? Why am I setting my profit target so high? In the next, when I move down here on the slide, you're going to see exactly why I do that. I don't want to limit my upside. What happens if I put on a trade and then all of a sudden I get 3 large candles that are 50-point moves going in my direction or selling off because I took a short position? I don't want to limit my upside. You can have that profit target, and in NinjaTrader, you can actually have those targets that are set out and you can automatically scale out of those positions. If you decide to do more automation trading for your trading style, that's fine. That's fine. I don't have that ability to do that here. I might be able to do that in Active Trader on TOS, but I currently don't have that ability. That's why I want to migrate over to a different platform. But here, very basically speaking, pay attention to the stop loss. The stop loss is just a couple points away, 30, 35 points, maybe 40 points here. But look at how much I'm looking to risk. It's $58. This is going to fluctuate, right? It's not always going to be $58. It's going to fluctuate $2, $3, $4. So when I'm doing that, right, make sure that stop loss, it's a template that you have set up in TOS, in IBKR, in Tasty, whatever. Make sure that this template is always the same thing. If you're always going to jump into at least minimal 3 contracts, then have that set up, and then you can move this relatively quickly. No one's going to be trading the 1-second chart where you have to be absolutely pinpoint accurate on your entries. You can move away 10 points from your entry and you can still get a pretty good trade. Don't think that just because, oh, okay, Sage is teaching me when this happens, when these conditions happen, that if it's 5 points away from my entry, then I can't enter any longer. That's not the point of this. You're going to have the ability to put on a position where if you're 10 points away from where I took my entry, it's still pretty good. On ES, maybe not the case. If you're 2 points away, then that's okay. But I'm specifically talking about NQ. You guys are going to understand after watching this for a little while how the points actually move. So let's go a little bit further down. This is a trade that I took recently. Notice, I'm going to point out a couple things. There's that tick system again, right? Everything is 0.25, 0.50, and then 0.75. You'll see that incrementally as you're moving within the points. Now, I took that at 973.25. I took 3 contracts, as I've been saying with you guys. 3 contracts, and I have the ability to scale out. Now, this is a market order. This is a stop order. If I took the entry here, this was a long. Why is my stop all the way up here? The reason why is because we moved and we gapped up over the swing that I took. So my stop loss is now being moved up. Now notice where my profit target is. Why is my profit target all the way up there? Because I don't want to limit my upside. I'm going to tell you from this trade, I made almost $11,000 on this trade. When this is starting to move up, you don't want to limit your upside. I don't think that is very smart. You can scale out of the position as soon as you hit one of your profit targets. That's perfectly fine. You guys can figure that out in your broker, and you can trade your system that way. That's fine. I'm not telling you to do any different because you're guaranteeing some profit. So I did scale out of this position. Of course I did scale out of it. And then I left a runner, just like you guys do similarly to when you're trading shares or when you're trading options. You take 5 contracts, you scale out of 3, you leave 2 runners, and then if you hit another profit target, you're leaving that last runner, so on and so forth. That's the same methodology, see? So options, a lot of how you're trading there is going to be used for futures. And then, of course, you don't have the same margin requirements as shares. So this ended up moving. I think it ended up moving actually past the 300 mark. I think we got up to 415, something like that. Did I catch the entire move? No, of course I didn't catch the entire move. This, at one point in time, did fall back into my ATR trailing stop loss, which is an indicator that's going to give you a little bit of a better sense of where you can set your stop loss, and then you go from there. Don't think that with trading futures, you're going to catch the perfect bottom and perfect top. No one does that, right? That doesn't exist in trading, but you're going to catch a fragment of the move, which is good enough. It literally is good enough, and you want to do that over a multitude of different trades, 50, 100, 150,000 trades, whatever. So what did I do here? I wanted to guarantee some profit. I had almost, it looks like almost a 0.6 move here to the upside. So I gave it some breathing room. And here you're not looking at an ATR trailing stop loss, but you'll see in TV how it is that I set that up. But in this situation, boom, I just moved that up. And if I get stopped out on the trade because futures are trading 23 hours a day, 5 days a week, that's fine. That's okay. At least I guaranteed some profit. That's what your goal is. If you are hitting at least the 2-to-1, then that's fine. In this situation, I want to hit an 8-to-1. Why? Because then I don't have to be right 90% of the time. All I need to do is win 20% of the time and I'm good to go, right? It's not so much focused on what the win rate is because I understand the ratio of win rate and risk reward. So in that sense, I'm putting that at the forefront. Let's go back here, right? Let's go back there. If I'm taking 3 contracts on this trade, or in the situation where I'm taking, let's say, 3 NQ contracts, this is going to be times 10. So if I do take the 3 contracts, this turns into $4,000, and then you multiply that by 3, it's $12,000, right? There it is. That's exactly what it is. Now you're also going to be multiplying that risk. So you got to be careful. You got to know what your numbers are. If you are taking a position where you're using 20% of your portfolio, that stop loss better not be set more than 0.5%. You see what I'm saying? If you understand those relationships. So going a little bit further down, this example fits my narrative perfectly because this is my trading system. Now, what did I use in order to fire that particular trigger? This is where the indicators come in. So on TV, I have the ability to set a predetermined risk reward. So notice that these are in ticks. It's not in points. So you got to be careful. You have to understand the relationships between ticks and points in order for you to decide what the numbers are going to be for you. With TV, you can attach your broker. And then when you set the order, right, it's 2 clicks. It's literally 2 clicks. And sometimes I already have that first click in, right? I already have the order that I want to send, either a long or a short order. And then from there, I'm just sending the order here on the tab below, right? Buy or sell. So automatically sets the trade. It's 1, 2, 3. And some of you are going to do this with hotkeys, right? Hotkeys are extremely beneficial if you're looking for pinpoint accuracy. So now going back here to the chart, a couple things that I was looking for. I have a squeeze indicator. I have my moving averages. And then I also had my target. That was my target area. That literally was my target area. So I moved up my stop loss to what my target area was. So I was already good with the reward. I was definitely, I planned out the trade. And this is what you need to be doing for every single futures trade that you will be taking. Are you going to be stopped out a lot? Yeah, you are. You definitely are. Are you going to be taking relatively small losses and incurring $50 loss here, 50 there, 50 there, 50 there, 50 there? Yeah, you'll probably take 5 losses in a row. But for the gains that you will incur, right, if you're taking the right positions and following along with what I'm teaching you, then I think you're going to be okay. You're going to say, hey, Sage, my win rate is 45%, but my risk reward has been 3-to-1. So it looks like I'm profitable overall. Cool. That's the goal that we're trying to reach here. So we went over a lot of information already, but hopefully what I've been able to do so far is giving you a baseline in what you need in order for you to start trading futures. So let's continue. Awesome. So up until this point, you understand the margin requirements that you need for the micros and also for the minis. And you also understand that this is more about points and ticks as opposed to percentages. Options are all percentages. Now with futures, it's all about point system and how much you make or lose per each point. When I jump into the broker, you're going to understand very clearly why I'm making this such a big point, because there is such a thing as options futures, right? It's the same thing as trading options on SPY, QQQ. Futures has that as well. But when we're trading futures, it's futures contracts, not futures options. Let's go into the tab one more time so we can look at the table of contents and see how far we've come thus far. We understand futures contracts, right? Contracts, options, very different, right? There are futures options as well. In the broker, you're going to see the difference. Next is going to be choosing a broker. I'm using Tasty Trade. Follow along if you have 2 screens. On the examples that I'm going to give you, and be practical about this. See, okay, I see what Sage is saying. Let me follow along and make sure that I have these orders set up because I'm going to be sending a lot of orders. You got to make sure that you get it right the first couple times because you don't want to be creating bad habits. Know the margin requirements. You already know that. I showed you here with the template that I made, how much money it is that you need. You need about $2,000 to $3,000 for you to start trading MNQ, and the same thing with MES. You don't need all that much money. So if you're losing $50 on each position, you got to calculate, all right, how many losses can I take in order for this to, start to become a huge problem for me? Think about those things before you start thinking just about the reward. Think about those risks. We'll go over technical analysis after the broker. So without any further ado, let's dive into that. This is going to be my broker. And right now you can see, just to make sure you guys understand what's going on, these are my recent symbols. This is my watch list, and I'm already looking at ES. So I have an order that I put in. I'm going to clear that order real quick so I can do this example and do this exercise. ES is what I have here to trade. Now, if I'm going to do SPY, check this out. If I'm going to do any sort of position in the market, SPY, let's get the right ticker here. And I want to buy, let's say I want to buy a 570 call for April 17th. I can do that. How much is that going to cost me? It's going to cost me about $400. Can I set a bracket order into that? Yeah, of course. If you're trading shorter dated options or longer dated options, perfectly reasonable to set bracket orders or OCO orders. Many of you are not doing this, but to each their own. If you want to have that risk on, risk off, that's okay. That's okay. Just know that that option is there. Now, how is this different than trading futures? The difference is that you are susceptible to theta decay. Notice here that you have your delta and you also have your theta. This is very important to point out. Now let's go back here to ES, and you're going to understand once again why this is so important to understand, because a lot of people make this mistakes. A lot of people are going into futures and then all of a sudden they're buying options futures and then they don't understand what they're doing. So let's go to April 17th, right? And let's go into that 5,700 contract. Am I buying futures right now? No, I'm buying futures options. So look at my theta and look at my delta. Obviously, you're going to have a delta with every trade that you take. So when you're buying into futures, your delta is going to be pretty static. It's either up or down from there. But here you have a theta value. This is still options. Even though you're in the futures or the futures ticker, this is still an options contract. Now, what is the difference between you doing this and actually trading futures? Futures is going to be binary. It's going to be either long or short. This is where you're using that particular strategy. So on all your brokers or all your platforms, be careful when you're going into the option chain. If you're selecting something off the option chain and you're selecting a strike, you're trading options. If you are going into futures and you're selecting a point or an entry, then that's equivalent to shares. Remember when I started, futures trading is just a combination of you trading shares and options. Both of those methodologies are going to be meshed together. You got to make sure that you understand this, man. All right, so let's go here. Is there a theta value to my futures position? No, because it's not options, right? That's the point that I'm trying to make. I'm spending 15 minutes trying to teach you guys this because it's so crucial. It's so important. There's no theta value to this. Can I set a bracket order? Yeah, of course you can. But notice, it's not about percentages. It's about points. So here, if I were to take this position, I'm looking to lose $337 on this contract, or excuse me, on this futures position if I lose. Now, what is the estimated profit? As you guys can see, the estimated profit is phenomenal. So with the examples that I gave you on my template, this risk reward is really good, but focus more on what it is that you can lose overall, right? Don't just focus on putting that profit target as high as humanly possible and thinking that you're going to hit that. For the examples that I've mentioned and several of the ones that I'm going to give you, I'm setting my profit target just a little bit higher just in case I get a run in my direction, either as a long or a short. I'm going to do this one more time. For the love of God, get this right, because it is important. You can really hurt yourself if you're not doing this correct. Let's use NQ as an example. I'm going to go to NQ, and if I'm going into the option chain, you're already incorrect, right? This is going to show you on TOS. It's going to show you on IBKR. It's going to show you on all your platforms. If you are selecting an expiration, it's already incorrect. But let's just, add insult to injury, and let's say I want to purchase the 20,000 call. How much is that going to cost me? It's going to cost me almost a little bit over $16,000. Fine. Or yeah, about 16,300. Cool. So I have this position. If I want to send in the order, right? Let's just say I want to send that. Futures trading session is not currently active, yada, 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 yada. Cool. But notice that I have a theta value. If it has a theta value, you already know it's an options position. Now, how is that going to be different than me taking a futures position that is not options? I'm just going to use the long or the short tab here. Notice that there's a couple of different strategies that you can use. This is specific to my broker because this is more advantageous for an option seller, which is what it is that I am. So instead of doing options, you want to do futures. This is it. This is the golden nugget. They are not the same thing. They are definitely not the same thing. So when you are choosing your strategy, it's just like buying shares. It is no different whatsoever. So if I want to do a short futures, I'm going to go to that, and then that's going to propagate up here. Notice what the theta value is. There's no theta value. And then I already have my predetermined template for my bracket order, which all of you are going to have in your broker as well. This is how much I stand to lose. This is how much I stand to make. I can't send in an order now because right now the market is closed, right? It's during the weekend, but this is how it is done. Cool. We're going to do just 2 more examples. I want to really, really bring this to the table so y'all understand. Let's do it on a different ticker. Let's go to RTY. If I'm going into the option chain, you already know that it's incorrect. So do I want to go long or short? This is the long way to do it. You guys can do this on TV, which I'll do that when we get into the trading view example. Long or short, right? It's just a binary choice. Do you want to go long or do you want to go short? If I want to go long, here it is, right? So that's one button that I clicked. This is another button, and this is another button, and then this would be the final button. It's 4 buttons. So in those milliseconds, you're losing precious seconds on when you're looking to take the trade or not. This is why I would prefer that you would have a broker that lessens the decision-making process overall. So here it's 4 buttons. This is inefficient. Getting into TV, when you link your broker or when you're using NinjaTrader, Tradeovate, you can do this in 2 buttons or maybe even with just hotkeys. So cool. You guys understand how to set this order. Let's do that final example. Let's actually do bonds, right? If I want to take a long position on bonds, or a short position, I can do that. If I'm using the option chain, it's already incorrect. I'm going to either go long or short here. Let's go short for this example. So I have my bracket order. I understand how much I stand to make, how much I stand to lose. Risk reward looks good to me. I understand where I'm looking to take my entry price. I understand where my stop loss is, where my take profit is. Review the order, and then I'm going to send that order provided that the session is open. That's it, right? Nothing hard about that at all. We're We're going to start diving into the technical analysis aspect of this. In the last couple minutes and last couple segments, we spent time on the back end. The back end is not that hard to figure out. Make sure you understand the difference between futures options and futures contracts, because we just went over for about 10 minutes on what those differences need to be and why you need to understand them. The back end is going to do exactly what the back end is designed to do: fire the signal, take the stop loss, and be mechanical. Now, the decision and the discretionary part of this is you on the trading floor, so to speak, right? You're in front of the monitor and you're going to make those trading decisions, which will fire to the back end. We want to make sure that these two things, they're communicating correctly. Now, what I mean by that is if they are taking the input from the front end, you're not going to blame the back end. The back end is that engine. The front end is basically you. You want to try to lessen the decision-making process. Try to make it 1-2 clicks and pretty much very responsive to you taking the trigger, deciding whether you want to be in the position or not. And then if you're wrong on the position, the back end will take care of you because you're using those stop losses. So without any further ado, let's talk about the technical analysis segment. We're going to spend some time here, right? Because there's a lot that I need to get into. Some of you already know technical analysis very much in depth because you've been trading with me for a while, but some of you have never even heard of certain indicators that I'm going to go over. I'm going to explain in great detail why it is that I'm even putting it on the chart. I'm not using it to overcomplicate my trading system. I want to try to simplify it, but all of the little triggers and all of the little conditions and indicators that I will be showing you are there for a particular reason. My job is to convey why they are there in the first place and taking the buy and sell signal every time that these things line up or don't line up. So let's get into that. Welcome to the technical analysis segment. I've already done the job here in building the watch list for you. So if you want to copy the exact watch list that I have, please feel free to do so. I want to just point out one thing. I'm on ES. ES is the same thing as MES. This is just to point out that they're identical. The only difference is the micros and the minis on the back end. So let's start building the trading floor and understanding where we're taking specific signals or where we might not be taking a specific signal and waiting on something. So we're just looking at candlesticks. This is as bare as you can possibly get. I want to incrementally add different indicators, but explain to you why it is that I'm adding them in the first place so you have context, because I don't want to go into a chart and say, okay, this is all the stuff that I'm looking at, and then good luck. That's ridiculous. What would make more sense is us talking about, all right, why am I putting this on a chart in the first place? And what information is it conveying to me? Is it going to be infallible? Are you going to learn in the next 45 minutes, 30 minutes? I'm going to use Sage's trading system and all of a sudden I'm going to be a trading god? No, that's not how this is going to work. But you're going to understand, okay, I'm going to modify what it is that he's telling me, and then I'm going to use that in order for me to be better prepared, better educated, and understand the implications of what I'm doing, understand my risks, and actually know that I can trade on my own without having my hand held. And I can do this if I'm looking at an opportunity based off of my experience. Maybe I can catch something where I don't need a particular signal, or I just don't need input from anyone else because I'm trading off my own experience. That's what we're starting off from, even before we jump into the indicators. Understand that that's what our goal is in the next couple minutes that we're going to spend together. So you're looking at the ES, right? ES and NQ. I'm going to use that interchangeably because the chart is a chart is a chart is a chart. First thing that I'm going to put up is going to be the moving averages. I like the moving averages because they are very consistent and they're as close to real time as we can get. With every indicator that I put on my chart, with the exception of the voodoo lines, the voodoo lines is going to be the only indicator that I'm going to share with you that is a paid indicator. All the other ones you can get for absolutely free with your subscription with TV. I think that you don't even need a subscription for the majority of the things I'm going to talk about. But all in all, the voodoo lines, which I will explain again in depth, are the only things that I would quote unquote pay for if you decide that you want to go that avenue. But to be perfectly honest, do you need them? No, they're just a nice little crutch that we use to determine supply and demand. Okay, so let's start building out this chart. I just mentioned the moving averages. I'm going to use a stack that you're probably not used to. Most of you are using the 9, the 13, the 21, and of course you're using for the longer dated moving averages, the 50, the 150, the 200, so on and so forth. So I'm going to put those on the chart to start off. Let's put the 5, let's put the 9, let's put the 13, and let's put the 21. I just like knowing where the moving averages are because, statistically speaking, I'll include a couple articles when I post this video. They are probably the indicator that's going to give you the most up-to-date information that doesn't have any other input. There's not a lot of code that comes to this. It's more based on volume. They are going to give you at least the most accurate information based off volume that you can possibly get aside from the candle input information. What that means is when you're looking at the EMA or SMA, I particularly like the EMA. I'm more partial to that because it's a little bit more fast. When you're looking at that, I'm using this as my firing of either a buy or a sell signal. Now, relative to the different time frames, if you're going to go off the 1 minute time frame, you're going to learn here in a little bit that there are a lot of signals that you can catch. Now, am I using the moving averages by themselves in order to propagate the buy or the sell signal? No, but it's going to be, I would say, one of the first things that I look for. On top of that, I'm going to use something called the CVD. CVD stands for cumulative volume delta. That's going to tell me behind the candles, if you're using footprint charts, if you're just using any other volume indicator, it's going to tell me how much volume and that change in delta relative to each candle that's coming in. You're going to see what that looks like here in just a second. So I'm going to remove the squeeze, and we're just going to put the CVD. Forget the ATR just for a second. We'll talk about the ATR in just a bit. So we'll remove that, and the CVD is just telling me, okay, how much delta and how much volume relative to each candle is coming in. Like how much strength does it have? So you have a zero cross line, which is up here. And for this day, this last day, the zero cross line is all the way up here. So I want you to notice already a pattern, right? When I'm doing my own back testing, please do your own. Don't just take this just because I'm saying it. Do your own back testing. But I find that when my 5 is overcoming my 21, I'm looking at my CVD. If I start to notice that my CVD is no longer crossing the zero line, which is right here, if we are at the zero line, just like how the TTM Squeeze Pro works, if we are there and we're starting to sell off and I get a decent enough cross, let's zoom in here real quick. If I get a decent enough cross off of my 5 and my 21, I'm being very, very careful with my wording. My 5 and my 21, if I have a fast cross, let's actually outline here real quick so you guys see exactly what I'm talking about. If my 5 overcomes my 21 in this situation right now, it's undercutting it, then that for me is a signal to go short. Now I'm going to use that in confluence with my CVD. Now, if you are using any sort of oscillator, a CVD is basically an oscillator, but it gives you more information on volume, then this right here is already a recipe for you taking either buy or sell. Are you going to do it off of the 1 minute time frame? When you do your back testing, you can decide whether you want to or not. I'm going to be using a combination of either the 3, the 4, or the 5 minute time frame. On the 5 minute time frame, you will get less signals overall. The higher the time frame that you go, the less noise that you see, the less susceptibility to something that we call jitter. If you're an audio engineer, you know what jittering is. So same thing here. There's a lot of jitter when it comes to trading the markets because you're trading against high frequency trades that are being executed. So let's go back here to this example. If I'm telling you my 5 right now is underpinning my 21, then that signal is a pretty clear signal. Would I take that position based off the system by itself? Yes, I would. Just using this very simple system, for me, it's already enough. Now, I hate when people say, hey, that's obviously a short signal, dumbass. Of course, you're going to be taking that signal. I'm going to show you a couple of other examples where if you're going to take a long or a short, it's just going to follow these principles because I don't do replays, right? That's not how I trade. That's not how I teach. Everything for me is real world example. So if I'm looking at my 5 overcoming my 21, is that a signal for me to go long? Look at where the CVD is, right? I'm going to share with you, or I'm going to educate you right now on if we're crossing that zero line, that is not enough information for you to say, okay, I need to fire on that signal just because I'm crossing that zero line. So the zero line is that dotted line that you all are seeing right there. Let's see if this coincides quite well with my methodology. So if I'm on my 5, overcoming my 21, is that enough signal for me to take a long? I would say yes, that it is. So am I going to be catching the exact bottom here? A lot of you traders are going to say, Sage, you're giving up a lot of the juice there, right? You're not catching the perfect bottom, right? I don't know, and you don't know either. No one knows. In trading, if anyone says, hey, I know that was going to be a bottom, or if you have a faster indicator, if you want to be using the 1 day moving average and the 3 day moving averages, feel free. If you're back testing and your data tells you, hey, you're getting good signals, and when you back test that or when you forward test it, you're saying, okay, my hit rate with that is 72% and I can hit a 3-to-1 risk reward, then by all means, then you use that, right? You can use that and you don't need to tell anyone else. You just trade off that system. That's fine. But here, when I do my back testing, my 5 and my 21, you can even do this if you want to. You can release the 21, you could just use the 13. I don't find as good consistent signals with this, but to each their own. You can get just a tiny little bit earlier, but I did take the signal long. I've been reviewing my trades on YouTube. You guys have been seeing exactly where I've been taking my trades. I've been pretty transparent with this. So if you want to use the 13 and the 5 cross, that's okay. Generally, I have that stack on because I want to have some information. I want to know where my moving averages are. The 13 and the 21 are pretty significant. The 34 is also pretty significant, and the 50 is as well. If you want to wait for that additional confirmation, that's okay. I'm trading off the 5 minute time frame. If you want to use the 15 minute time frame, would you have caught that signal long? It's going to be a little bit more. You're going to have a little bit, I'm not entirely sure if you're going to be catching that long position and seeing exactly where you can underpin or where you can catch a long where the signal is very clear. So the higher time frame you're going, the larger the move you can catch. There's no question that that's going to be the case. But I have found with my back testing, between the 3 minute to about the 5 minute time frame is the sweet spot when you're looking to day trade. So now let's go. Let's just use this very, very simple trading strategy. It really is very simple. Let's use this very, very simple trading strategy and see exactly how many signals I would have caught throughout the day if I'm just using the CVD and just using the 5 and the 21 cross. Let's do that. So this is a very clear signal, right? Never mind the VIX, never mind 2 time frames, forget that. What is my risk reward on that trade? This is where the strategy needs to take place. It's not about you taking that buy signal and then taking it and all of a sudden that starts to move against you and now you have an egregious loss. That is the stupidest thing that you can possibly do. What you need to do is you need to implore and use the risk reward principles, the calculators. Depending on if you've ever watched any of my videos, I use the risk reward calculator on every trade that I take because it is the most important concept, right? Even as an experienced trader, you want to put that risk reward calculator on there and you got to know where you cut it quits, right? Where you're going to say, okay, I'm done. I've already done this work for you. I've shown you in the OCO bracket. I've shown you in my broker where it is that I'm looking to call it quits. As we progress through the lesson, right, depending on how long the lesson is, you're going to see where you have a recommendation off of an indicator where you need to set the stop loss. It's called an ATR trailing stop loss. It literally tells you, okay, based on the volume that's coming in, right, the ATR, based on that volume or that volatility, this is where we can cut the position because that sell or that candle that, gave a little bit of the profit back, it wasn't really substantiated by a lot of volume. That's how that works. So let's say I want to take this position. Does that already have good risk reward? I would probably argue that I'm going to set the stop loss at about there. Okay. So if I do that, I have to have my profit target areas. So how are you going to set your profit target? This is not a lesson in where I'm going to tell you, hey, your profit target needs to be 20, 30, 40, 50 points. You're going to have to figure this out. For me, if I'm taking a position, I like profit targets at about 30 to 50 points. If I can get that, I have a good enough trade where I can take it and I can do this pretty consistently. If you have a profit target where you want to look for 100 points, that's perfectly fine. You can do that. The only thing that I would urge you to do if you are going to use this system or trade exactly how I'm teaching you is that you want to have very good stop loss management. You have to be perfect when it comes to this. Maybe perfect is not the word, but you have to be surgical, clinical. What I mean by that is you're not moving the stop loss ever down. That is the worst mistake that you can make as a trader. Never, ever, I'm telling you now, ever move the stop loss down because you are messing with your risk reward. If you start messing with this, check out the ratio. What does the ratio look like when you're making this ridiculously stupid decision? Then your risk reward now is all wonky. So when you're looking at your data and you're looking at your back testing, if you're doing that, the back testing is not going to pick up on that. But what is going to pick up on that is the last 50 trades that you took that you move your stop loss back 35 times. That's what's messing up with your profitability. So predetermine what the stop loss is going to be. If you're going to move anything, move the stop loss up. My main goal and the way that I'm going to educate you is that if you get at least a break-even trade because you trailed that stop loss up correctly, for me, that is a winning trade. If you can get 20 break-even trades in a day, for your fees, you're probably going to pay, let's say, $20, $25 for your fees. That is an acceptable trading session. What's not acceptable is you taking 15 losses at 20% each, or in this case, 20 ticks each, just because you are moving down that stop loss. That is such an important concept. And that's why I'm spending so much time on this. Because if you do that, and you come to me and you say, Sage, I was following your trading system to a T, and then I'm looking at your data and I'm saying, okay, let's see what you did here. Your risk reward didn't make sense here and you were moving back your stop loss, right? Because I can notice that in the data. Then I'm going to say you have not been following what I've been teaching you, right? This is not the way to do it. So let's continue. You have your first profit target. I'm going to use, without any gatekeeping here whatsoever, I'm going to use the voodoo lines to determine what the profit target areas are going to be. We'll talk about that after we talk about a couple of other indicators. Let's just go over how many signals I would actually get in a trading session. We're going to do this for a couple of them. We'll do this for like 3 trading sessions. I have a legitimate signal right there. That is a legitimate signal that I will take 10 times out of 10. Do I know that we're going to be running 70, 80 points here? Let's see exactly how many points we're going to be moving. This is the thing that most of you don't understand. I don't know that that's going to move 150 points. If anyone says any different, it's not true. It's not true. Do I know that that's going to run 150 points? I want to at least get to 30, 40 points, at least. If I can get to that, then I'm good. If I want to do this off of the 2 or the 3 minute time frame, that's okay too. Then you're going to get the signal a little bit earlier, but you're going to get a lot more signals throughout the day. And you're going to get a lot of false breakouts or just false sell-offs, right? Do the back testing. Don't just take my word for it. I'm going to say that a couple times in this educational series. Look at the back testing. You're going to get the signal maybe a little bit earlier, but you're going to be susceptible to a lot of the bias that you have on the shorter time frames, and you make it a little bit more of an emotional decision. Remember when we went over the chart that I showed with you? What was one of my last bullet points? 3 to 5 trades. If you're doing more than 3 to 5 trades, then you're not trading my system. You're not trading with an edge. The whole point of you learning and spending time on these videos is for you to trade with an edge. This is an edge. This is literally it. So you catch the signal, boom, you already got one winning trade. This is a trading day where I made almost about $5,000. So I have that one, boom, I fired the signal, and I get a pretty good, I get 90 points on this move. Fine. So as soon as we start, if I'm putting on the ATR, the trailing stop loss, right? If I'm putting that here, this is going to give me some sort of sense of where I should be trailing that stop loss. Let's zoom in on this just a little bit, right? So the ATR trailing, don't worry, I'm going to share it with you on the indicators tab where you can find these, right? So you guys will see exactly how the script is written. So if I take that trade right here, my stop loss should be approximately there. What did I do when I put on my stop loss calculator? I took my long position and check that out. Where was my stop loss roughly? At about the bottom of that wick. So that coincides pretty well with the ATR trailing stop loss. If I'm going to follow that, or if I'm going to automate this, because you can automate this process as well, depending on what broker you're using. NinjaTrader does this quite well, so does Tradeovate. I'm going to be stopped out approximately on that wick, probably there. So how much realistically, what is the point value of me getting wicked out? About 104 points, right? So what was the entire move? The entire move was, let's just say, give me 1 second so I can calculate this. The entire move was 160 points, but I got stopped out at 104. If you are the person, I'm going to tell you because there's two schools of thoughts on this. Sage, I could have taken that all the way up to 150 points. You're an idiot. You don't know how high you're going to go. You didn't even know that if you took this trade, you're going to move 20 points, 30 points. You have no clue. So if you are applying what it is that I'm teaching you, the whole point of you putting on that trade is for you to catch a snapshot of that move, not the entire move, not the entire thing, the entire sell-off or the entire rally, but to capture a snapshot of that. What would have happened, or what would you have said? Think about the opposite side of this. Think about if you didn't hit that trailing stop loss or that suggestion, and you started moving up from there an additional 200, 300 points, like I did on the example that I shared with you on the tab that I made. In that situation, yeah, we did curl back, and I wasn't using the ATR stop loss at that point. But had I been using that, I did my own back testing, I would have caught almost a 400, 450 point move. So in that situation, put yourself in the mindset that, okay, I don't need to catch from the bottom all the way to the top. I'm already not catching the bottom. How do you possibly know what indicator out there or what trading system is going to say, hey, that's an engulfing candle, and from here, that's the bottom, that's the top? There's no trading system and there's no algorithmic trading that will be able to capture that. It is impossible. But here, you can catch enough of the move and be successful enough that you can do this day in and day out and be a day trader and actually be successful. Cool? So let's remove that. Let's remove that. Okay, so I'm stopped out here. Let's talk about other legitimate signals. I'm really, really diving down deep into these examples because you need to clearly see, if you're not watching me at 2x speed, if you're watching me in just regular speed, you probably want to watch this a couple times over, where it is that the signal is outlined. We're just using the 5 and the 21. You can do your own different little combinations. This is the one that I found that's best for me. I'm going to point out another signal. I think that there's a pretty clear signal right here, not just because of the moving average, but look at what the CVD is telling me. So just like the TTM squeeze, or just like any oscillator, which I'm going to put on the chart here in just a second, it's telling me, okay, that's the zero cross line, and Sage is saying, okay, we're overbought. We're overbought on the 5 minute, or in this case, the 2 minute time frame. Let's go here to the 5 minute. We're overbought. So on the 2 minute time frame, I would have been in there maybe a little bit earlier, maybe a tiny little bit earlier. So let's go back. Does the signal, check this out. This is really cool. This is a happy little accident. Does the signal condition change because the time frame changed? No, it doesn't. Hopefully I was able to point that out, man. So the 4 minute time frame, the 3 minute time frame, the 2 minute time frame, the condition is still being met. What is the condition? The 5 and the 21 cross. And on top of that, the CVD, right? So CVD is going to tell you, where are we on the overbought or oversold spectrum? And it's going to tell you behind each candle how much volume is behind that particular candle. If it's an elongated candle, you know there's some volume behind that, so on and so forth. This looks very similar to the candles in and of themselves. So you might say, hey, that just looks like a copy. It might be so, but sometimes when we're in a choppy market, it'll tell you if those volume candles are shallow or not. Okay, so sometimes this might look very similar, and you're saying, Sage, it just looks like the candle chart. Yeah, that might be. There also is just a regular volume delta. I'm going to share with you what that looks like. If you want to look at this in a different light, just put in volume delta. So you don't have to look at potentially two candlestick patterns. So here, you're looking at just the histogram line right there, and you see exactly how much volume is coming in or not coming in, right? So this is just a different way to look at it. Both are valid. Both indicators are going to be valid. Remember, everything in trading is based off of imbalances and based off of supply and demand, and also exactly how many buyers and how many sellers and which ones are taking into control. Everything else, all other mathematical computations, as complex as they may sound, right? It's just all about volume. It's just all about volume. All right, so let me remove that and let's talk about some different signals. That would have been a signal right there. Did I take that signal? Yeah, you bet I did. So what would be another valid signal if we're following this trajectory and we're following this methodology? Let's do that. That's a signal. Is that a signal right there? I would argue that it is. Did I take that signal? Yeah, you bet I did. So what would be my target area if I'm doing that? I'm going to target the high of day. Did I make a little bit of money on this trade? Yeah, I did. It wasn't a lot, right? It was maybe 5-10 points that I caught. Fine, it is. This next signal, I didn't take. I didn't take the signal, but it was a valid signal. So let's talk about that. How many signals do I need to catch throughout the day? I said 3 to 5. I did notice that I'm on the 2-minute time frame. You guys are going to see the point that I'm trying to make. On the shorter time frames, you're going to get a lot of these little crosses and these little signals. If you're going to take every single one, look how many trades you're going to be taking. There's that. Let's see another one. You got one there. Okay, that's a pretty decent one. This is a signal cross here. You would have been probably stopped out at a relatively small loss. That's fine. You would have taken that signal there. So how many signals are we coming up on overall? If you're doing this many trades throughout the day, you're not following my methodology. Not at all. This would not be considered a signal because you would have already gotten in here, but you would have caught a nice move to the downside. How many do I have overall? And this is not a signal too because we got it right here. That's 1, 2, 3, 4, 5, 6, 7, 8, 9. That's 9 trades. Now let's go here to the 5-minute time frame. You're going to see how a lot of this noise, quote unquote, it's just there. It's just on the chart. So off the 5 minute or the 4 minute time frame, either or, you decide. I would have been a little bit earlier on the 2 minute time frame, but all in all, the methodology is still being followed, right? You guys are going to see a continuation line. There's nothing that I'm going to say throughout the presentation where there's not continuity. There can't be. If there's any inconsistencies in a trading system, then the results are going to be all out of whack. So I have a legitimate signal there. I have a legitimate signal here. Now on the 5 minute time frame, I don't think that I would have followed suit on that. I did. In this particular situation, I did, because I was thinking high a day, and that's where we're going. So I'm already eliminating that signal. See that? This signal can be eliminated. This signal I probably would have taken. I think it's legitimate. Get rid of that, and that's a legitimate signal right here. So I've already gotten rid of a couple signals. So let's see if this is following along with my overall trading methodology. 1, 2, 3, 4, 5. That's about 5 signals. How many did I say were legitimate signals throughout the day? About 3 to 5. This follows along with that quite well. If you want to have a happy medium between the 2 minute and the 4 minute time frame, you can jump into the 3 minute. And then you can, what am I doing? This is one of the examples that I shared with you guys. I said, okay, if we're going to review our trades, this is how I'm going to do it. I'm going to use exactly what I'm showing you here, and I'm going to go over these trades every single day so I can look to improve that 0.1%. If you do that, that starts to compound. 10 days, I'm already 1% better, and then you go from there. How many trading days do we have throughout the year? 255. So slowly and incrementally, I start to improve and start to see what is noise, what's not noise, what fits my trading system, and what doesn't. So we've gone through a lot of information thus far, right? Now let's go a step even further. If I want to have an additional level of confirmation so I can legitimately look and see if there is momentum that's being fired or not, or if it's a dry signal. Dry signal basically meaning, is there volume or is there significant volume behind it? What I'm going to do is I'm going to add the TTM Squeeze Pro. I'm going to leave these signals on. I'm just not going to do it on the 3 minute. I'm going to use the 5 minute time frame. I'm going to put those and leave those on the chart. And we're going to see if these are substantiated by an additional squeeze indicator. You do not need to use the squeeze if you don't want to. That's fine. But I'm going to share with you why it is that I have it on my chart. And if I'm looking at 5 trades, how am I going to maybe lessen the amount of trades that I'm taking? Or maybe I'm going to take a little bit more using the squeeze or not. So let's check that out. So now the squeeze indicator is on. Let's remove that. Give me 1 second. And I'm going to put it here on my chart. So you go into the indicators. The one that's not paid, just go into TTM Squeeze Pro. And you're going to use this one here by Beardy Fred. Same thing. So I'm going to use that. And I'm just not going to use the CVD here real quick. And let's just see if this lines up with the narrative and if we are looking for an elongated squeeze or not. So we talked about, right? I'm going to put the CVD on in just a second. You guys are going to see how I use this in tandem. So I'm looking for specifically an overbought or an oversold where the risk reward is going to be more apparent and better situated on my side. This is where we're talking now about an edge rather than an opinion. You guys hear me talk about this all the time. I constantly say, do not trade your opinion in the market. Trade what it is that you're seeing. Even then, even when we're trying to be as mechanical as possible, we're still missing trades and we're missing opportunities like the sell-off that we saw recently. So does this coincide quite well with my narrative on the 5 and the 21, one crossing over the other? Let's just see if this lines up quite well. What do we have in terms of the indicator? What is the indicator telling us? When we're looking at the red and yellow bars, the closer we are to the bottom end right here, the more oversold we are for the time frame that we're using. So in this situation, we're looking at the red, we're looking at the green little dots, and then we also have orange dots that come in every once in a while. When we start to see the green dots that are firing right here, we potentially have volume that's coming in. So when this is starting to oscillate off the bottom, when we start to see this sort of directionality, then we might be looking at a potential squeeze firing to the upside. Now, how can we substantiate that? We can substantiate that with the price action that we saw historically speaking, right? I mean, it's pretty simple for us to point this out. So look at where the cross is. This is really, really interesting. The cross is approximately at 0.48, or let's just call it 0.50, right? Let's put it at that, off of the 5 minute time frame. So let's move that up there. Would I instinctually look to take that signal? Probably most of you are going to say, hey, Sage, I probably would have taken it off that candle. I would not have done that because it's not following my system. My system needs to be followed to a T. Why? Because it is repeatable. Because if you do this, if you're looking at these conditions, then you have something that you have confidence in taking. But not just that, you understand, okay, this is where the system works and this is where it doesn't work. That is so crucial. Absolutely crucial. So we were coming off of an oversold pendulum. And then the zero cross line, where does that line up? That lines up at approximately 0.55. So my EMA cross is just 5 points ahead of the overall curve. So between 0.50, 0.55, is it going to matter if you are pinpoint accurate on the entry? To some of you, you might say, yeah, I want to be exactly the tick that's most accurate. That's okay. I don't need to be that accurate in order for me to be successful. What does need to happen is if I'm putting on a trade, if I have four buttons that I need to press, then I'm wasting time. So this is why I said, if you're going to take the trade, you're going to go here to your trade panel, your trading panel here. You're going to link up your broker, and then off to the left-hand or right-hand side, you can do this pretty automatically, and you're just waiting for the order. So you can have that order predetermined so you don't waste these precious seconds. So let's go back here to the example. Am I going to take this first trade if I have a green dot squeeze firing here to the upside? And that green dot started to appear once again, once we got up to approximately 115 points. So that's already a 65-point move. So you have something here. You have something that's repeatable and that you can backtest and that you can go back and visually see exactly where the person took the trade. So you can take this and superimpose it on any other chart. It's going to be the same results. So let's say we take that, cool. And then we get stopped out right here. Where would I fire on the short signal if I were to take that? Well, let's see if the opposite is true. We're losing momentum here on the oscillator, which the oscillator also might be some sort of indication that, okay, we're losing momentum. I probably want to be taking my profit there. You can use the oscillator as if you want to fire or if you want to take off for a take profit, if you start to see that oscillator is moving momentum, you can take that as a signal for you to take off the position. That's perfectly fine too. I'm going to use the ATR because it seems like it's a little bit more finite. That's what its job is. So let's see where the ATR is going to be. So the ATR is going to give me, okay, in this situation off the 5-minute time frame, maybe the oscillator was a little bit quicker. So whatever you decide to take your profit at, this would have sacrificed almost 15 points, almost 20 points in profit. And this can be adjusted. But in this scenario, it kind of looks like that candle and that invalidation for the 5 and the 21 cross seems like it took hold. Cool? All right, so that's fine there. Now, is there a signal for us to take here on the short side? If you are following my conditions, we're losing some oscillation here and we're losing some momentum. And we got the 5 overcoming the 21. Is that a signal for you to take short? Let's remove the ATR there. Is that a signal for you to take short? How many points would you have caught on that? Realistically speaking, I probably would have set my stop loss at the top of that candle. So I would have been hit on that stop loss at approximately, let's say 0.85. And let's see how many points I would have caught on this. So 0.85 back down here, I would have approximately caught about 40 points. So that's a second winning signal. Cool. You see how I'm following along with this? Now, does this follow my theory on the oscillator and the moving averages coinciding with one another? This is called confluence. If I'm putting the CVD on there, that's a third level of confluence. So cumulative volume delta, there it is. Okay, so these are almost telling you almost the same thing. Is and it isn't. It's presenting the information a little bit differently. But if I have these three things lining up, this is all you really need. Honestly, this is all you need. All the other stuff that I'm going to share with you about using two different time frames and using the VIX and using the tick, cumulative tick, they're just the different levels of confirmation that you can use to compound. But overall, if you want to keep the system pretty simple, this is really all you need. If you're using a different oscillator, if you're using the RSI, if you're using the MACD, just make sure that when you do your reverse engineering and your back testing, that they are telling you the same thing, right? 3 levels of confirmation that are telling you buy or sell signal. You can't be putting on too many indicators on there that are giving you crisscross signals because they're part of different systems. You can't buy a Ferrari, a McLaren, a Lamborghini, an Audi R8, take the parts and then mesh them together and expect that you're going to have some supercar. They need to fit, right? The systems need to fit. If you're going to build something, make sure that it's not Jimmy rigged. Make sure that they actually make sense when you are compounding them. Okay, so let's continue. Is that a signal to take? You can argue that. Now, here's the criticism. And this is when I was reviewing my trades, I was like, okay, I was looking at this, but our oscillation was not crossing that zero line. So that was a false signal, right? That's when I'm going to review my trades, I'm like, okay, I kind of took that trade preemptively. It was following along with my system. I thought that there was going to be more of a breakout here and we're going to see high of day. I was wrong. Did I cross on the zero line when I went into the signal? In these two situations, I did, but here I did not, right? I was still on an oversold on my oscillator. So that is a bad signal. Let's change the color on that. Let's go here and let's set it at red. So there's a bad signal there. Now, what about here? Is that a legitimate signal that you would have put on? I would argue that yes, this is an attempt for you to take a signal, but look at that oscillator. Are you in an oversold environment where you are overcoming that zero cross line? You came very close. So is this a legitimate signal? I would say that it is. Does it mean that every single trade that you're going to take using this is going to fire and going to be a 50, 70, 100-point move? Of course not. This is where the stop loss management comes into place. So when I did take this trade, which I did, when I'm looking to take this trade right there, my stop loss management needs to be pinpoint accurate. It needs to be absolutely phenomenal. So I came into my profit target area. Do you think I made money on that trade? What do you think I did? I took my stop loss and then I just trailed it up, right? So trailing it up just to make sure that I'm getting back to break even. And in this situation, I made maybe 5, maybe 10 points. And then I got rammed by that one candle. Now, had I set my stop loss at least whatever it is, 20, 30 points, maybe I would have caught this move here to the upside. But on an aggressive candle like that, I'm not looking to play with the market. I got stopped out on the trade and a relatively small gain, but that's all good. That for me, if you are trading the way that I'm teaching you, is a good outcome. Either a stop loss or a very tiny profit you can work with that. You can work with taking small profits 10 times a day. If you are losing 3, 5 times in a row, then your day is done. All right. If you lose 5 times in a row at $50 each, it's a $250 loss for the day. All of us can live through that. And this is what I'm teaching you. If you follow along with what I'm telling you, you're never going to run into those massive losses if you're not going overly aggressive and if you're not oversizing. So let's look and see if we have any other signals here for the day. So that would have been a long signal. What about that? Is that a legitimate short signal? Let's put this in yellow, right? Because yeah, it was a good signal. It was managed correctly, so we'll put it in yellow. So that's a bad signal right there. So first of all, one legitimate signal, one bad signal, legitimate signal. And then what about this? Is that a legitimate signal where we are crossing below the zero line? Look at the volume delta right here. So would I have fired on that particular trade or right around here? Probably I would not have been pinpoint accurate. More than likely, I would have got in at 0.60. More than likely I would have. So 0.60 back down where? This is exactly how I go through my trading reviews, by the way, guys. So you guys are spending time with me right now, but this is how I'm going to go over all of my trades. I'm not going to spend 3 hours reviewing my trades. I do this in roughly about maybe 15, 20 minutes, and then I go about my day. And then I'm looking to improve on every strategy and every execution that I'm looking for the next trading day. So here, how many points would I have caught? Maybe about an 80-point move to the downside. Would I have trailed my stop loss? Yeah, more than likely I would have. So where would I have been stopped out? Probably I wouldn't have been stopped out on this trade. I would have held on to the trade and see how it went. I can't tell you because I didn't particularly take it. But had we held on to that trade, let's see exactly how low we could have gone. More or less, you would have set your stop loss maybe at 0.30. I think that's reasonable. Because how many points did you move off your entry? You moved your stop loss and profit by 30 points. How much of that move would you have caught to the downside had you taken that trade? Let's see if you did get stopped out. More than likely, you would have caught this entire move here, right? Am I saying anything out of pocket? No, I'm not. I'm not saying anything out of pocket. Is this following the overall methodology of you looking for the zero cross line on your TTM, looking at your CVD, and looking at your 5 and your 21-day moving average cross? No, and that's just off the 5-minute time frame. Now, are you going to fire on every single one of these signals? You probably will, because 1, 2, 3, 4, 5 legitimate signals. I said not to go over 5. But you would have won on one. You would have won on this one. You would have been maybe stopped out on that, right? So that's, theoretically a win. You would have won on this trade, and more than likely you would have won on that trade. Is it always going to work out like this? I've said this 100,000 times already. No, it's not going to work out always. What's going to be magical about this trading system is how well you manage your stop losses and your risk on every trade that you take. So more than likely, ladies and gentlemen, if I'm looking back on this and speaking not just in theory, but also in practical terms, there's a good chance that you would have caught this entire move to the downside, provided you got into that signal towards the end of the day. It's perfectly legitimate to substantiate that. Let's do one more example. We're going to do this a little bit quicker, right? We're not going to spend so much time as we just did. Let's go over that system off the 5-minute. Oh, Jesus, man, this just follows along so well. All right, so we got a couple signals here, a couple signals here, but let's see where we can legitimize the trading methodology. Did we get a legitimate signal approximately there, or maybe around here? I think we did, okay? So we're losing momentum here off that arch on the TTM squeeze. And now what we're doing is, let's say we take an entry approximately at let's say we take an entry at 460. Let's just say that. What is my stop loss area if I'm taking a position using the 5-minute time frame? Let's put that on there. Let's see if we would have been stopped out following 30, 40 points. So maybe I'll set my stop loss there, and I'm looking at my profit target. I'm going to set my profit target at something reasonable. Let's say 60 points. Okay, so that's a decent profit target area, right? It's perfectly decent. Is that a legitimate signal since we're coming off that oscillator? Yeah, I think it is, right? Is it ridiculous to say, hey, I would have caught that entire move to the downside? No, I don't think it is. Did you get any zero cross line, or did you get any potential signals that you're looking off of the 5-minute time frame throughout the day? I think the only legitimate one would have been right here. So more than likely, you guys would have taken off your trade. More than likely, we would have been stopped out here. If not, right, if you're trailing by 30, maybe 40 points, maybe not. Maybe you caught the entire move to the downside. Here, I would have tried a second signal. If I'm following along and not being picky and not trying to drive my narrative here, more than likely I would have signaled that trade or would have taken it. On the 5-minute, I'm not entirely sure if no, it didn't overcome. So if it overcame, I would have taken the signal. So we overcame here, and let's just call that a small loss, right? I'm just going to say, for argument's sake, I would have taken the signal. I wouldn't have, but let's just say I would. I would take that, and then I would take that. So I have one banger of a trade right here. I'm taking it pre-market, and even if I didn't take it pre-market, you got pretty close to almost the signal there, but you guys are using pre-market now because you're trading futures. So you have that legitimate signal, then you have a semi-legitimate signal here, and then you have a legitimate signal right there. There you have it, 3 trades, right? You're not going over 5. You go over 5, you're not trading my system. So that's it. Where are you on your histogram right here? Where are you on your CVD? You were rejecting your zero line, and then right here you saw your oscillator pointing down. Are you going to take the signal right there? Maybe. I mean, you might do, but I would argue that the signal came in almost about 15 to 25 minutes earlier than that. There it is. You guys want to do one more example? We can do one more example. Let's do the previous day to that. This is more of a complacent day. These are what we would call chop days. Do we have a legitimate signal here following my system? I think we do, right? We're oscillating here to the upside. We're over the zero line right here. So yeah, this is a perfectly legitimate signal. Where would you be stopped out? Approximately where I saw that right there. What about another legitimate signal? Do we have one approximately here? I'm using approximations, right? It's nothing, it's never ever exact. But approximately, yeah. Would I have been stopped out on this trade because I wanted more of a move here to the low of day? Yeah, of course. Of course I would. Would it be a large loss? Well, it's either going to be a break-even trade or it's going to be maybe a 10-point or 5-point in a stop and profit. So cool. Is there a legitimate signal right here? I think that there is a legitimate signal. Don't conflate the fact that there's a legitimate signal, but there wasn't a substantial move that moved in one direction or the other. That's not the point of this exercise. The point of the exercise is for you to fire on the signal and just look at if the oscillator is telling you we might be pointing in the opposite direction or not. You don't know which one of these signals is going to be the banger trade. You have no idea. That is not your job. Your job is to identify where the buy and the sell signals are so you can put yourself in the situation where you can catch the banger trade. You're going to see an example of that in just 1 second. That's a legitimate signal. More than likely, you're either stopped out at break even or you made somewhat of a gain right here. So far, we have 3 signals for the day. Do you have a legitimate signal there? I would argue that and say, yes, you do. I would say, yep, I would probably take that as well. So that's 4 signals throughout the day. Do you have a legitimate signal right here? I would say that you do. So that is a signal that I would have been stopped out on, would have taken a small loss. Fine. That's cool. No problem. And then where do you have another additional signal? If you would have given up right here, let's say, okay, I'm still following. I'm following along with what you're saying, Sage. Let's see what else we got. There's also another legitimate signal approximately there. Why is it legitimate? Well, you're oversold here. You have the green little dots that are firing. So you might be moving into that territory where you're looking for a high day break. You didn't get that. You held this low right here, right? I'm not even talking about higher lows, higher highs. I'm not talking about structure. I'm just teaching you how to find the signals just off of 3 indicators, just 3 very, very simple indicators, the TTM, the CVD, and also the moving averages. So let's say I get stopped out and all of a sudden I'm frustrated. I don't want to be trading anymore. I'm a crap trader. Sage doesn't know what he's doing. He's teaching me all this crap and it just doesn't make sense. Yada, yada, yada. Cool. So 1, 2, 3, 4, 5. Here on the 6th trade, I'm already trading in profit, right? I already have profit. Let's say I'm up, just speaking relatively here, I'm up $250 on this 6th trade. On the 6th trade, if you want to cap it out at 5, that's okay. That's okay. I probably would have said, I'm done. I made my $250 today. I'm good. But had you followed my system right here, boom, probably would have fired there. Now, I'm going to tell you, I wouldn't have caught this trade. I'm going to tell you right now that I wouldn't have caught it. The reason why is because I didn't get the green signal until we got up to 480, right? So I didn't get that. I want to get the extremes on one side or the other. So let's put that into perspective here for just 1 second, and then we'll call it a break because we've already talked about a lot of information so far. So where are we looking at those large oscillations where the risk reward is just so good we have to fire on the signal? Here, I would argue and say that this is probably not the best A+ setup. The reason why is because we weren't oscillated dangerously here to the low side. We did have that oscillation back down here. This is a perfect example, literally perfect example of where this strategy is going to outshine a lot of other strategies. Right here, where we're overcoming the 5 and the 21, and then we have that oscillation that is beautifully oversold, and then we have that almost perfectly lining up with the zero cross line coming from that oversold environment and then looking to catch some momentum to the upside. In this situation, I mean, this is just going to outshine everything else. Where are we catching a riff here? Where are we catching some of the move in the ocean? We're going to be stopped out there, right? So 127-point move, right? That is a legitimate move that you would have caught. But where are we realistically looking to be stopped out? At about a 90-point move, right? Good enough. It's about 70% of the overall move. That's what we're talking about here. That's the magnitude of what we're talking about. So look at these oversold and overbought conditions. Look to see when they're extreme. If you do see an extreme nature throughout the day, maybe you would have filtered out maybe that signal. Actually, that signal I would have taken. I'm not going to say that I'm going to filter that out. Maybe I would have filtered out one of these trades, maybe one of them, not all of them. I probably would have filtered this one out. Wouldn't have taken that because right here, we're not in an oversold environment, at least not marginally speaking, not as much as we are here or even here. So that signal I would have taken. Maybe this one I wouldn't have taken, so I would have filtered that out. In this situation, I wouldn't have taken this trade either. I would have missed out on that because we were not in that oversold environment. This is a trade that just wasn't meant to be. But overall, we have 1, 2, 3 legitimate signals, including this one if you want to include that. You can ride that boat if you want to. And then we have one here for pre-market. So overall, 3, maybe 5 signals throughout the day. Hopefully, I've been able to convey at least enough, with enough intention, with the half an hour that we just spent together, that this right here, this is already starting to build a really good foundation of some of the stuff that we're going to discuss here in just a bit. Let's take a time out, pause the video here for just a second, stretch out your legs, make sure that you got some blood flowing in your brain, and then we'll continue with some additional parameters of what I'm looking for some of these trading setups. Cool. So we've talked about a lot of things up until this point. Hopefully, when I said to pause the video, you guys, stretched out a little bit, got your coffee, and right now we're in a good headspace in order to now actively participate in the next couple examples because it only gets better from here. It's going to get more interesting, and some of you, you're going to have some things click for you. I know that it's clicking for me as I'm learning this. Now it seems like for the third, fourth time in my career. But overall, when I'm using the backtesting, right, whatever backtesting software that you want to use, either TV, if you want to use some third party, doesn't matter. If you're doing the back testing and you can visually see, okay, this is where my edge is, then it becomes more interesting, right? So let's recap. You understand the point system. You understand ticks to a point. You understand the margin requirements. We talked very much in depth about you trading micros over minis, right? The minis are a lot of buying power requirement there, but the micros, not so much. You can take a position for $600, $700 and you're not putting that much up to risk, right? You're putting $50, $60, maybe $70 per contract. We talked about using the risk reward calculator. We're going to do more of that. We're going to refine that. And we're going to talk about the methodology of you using a stop loss. We did a little bit of that with the examples that I went over. I highlighted it more with technical analysis using the CVD, the TTM Squeeze Pro, and using the moving average combination, the one that works particularly best for me. I want you to come to this conclusion on your own, but I'll outline it just to have another point come across. Whatever trading style or methodology that you are using, if you can see how just thinking about 2 to 3 levels of confluence are going to remove the bias out of your trading and hopefully help you determine whether you're long or short, but for a technical reason as opposed to just an opinion or a feeling, right? Because we don't want to do that. We take a technical component, we fire on the signal. You're not going to win on every trade, but you're putting yourself in the situation where, okay, so there's going to be moves in the market. There's always moves in the market. Now I'm situated and I have my risk in place where I can ride some of these moves. You're going to see as we continue building upon the technical analysis segment where this becomes so much more fun and so much more optimistic when we're looking at the higher time frames. You're going to understand what I mean after we do another segment. So, make your coffee. I just made mine. I am already halfway through with it. And let's dive deep into adding more components to this so we can make better trading decisions that are more technically, statistically, mathematically based and that work off conditions as opposed to opinions. So, all right, let's jump into this because I'm excited to get into this as well. Welcome back to the trading floor. We're still on the 5-minute time frame. Now, I showed you briefly on the other examples that I was giving you where we're going to come here to using 4 different charts. Now, I'm going to explain the 4 charts, but just give me a second where I'm going to introduce now the voodoo lines. Remember what I said when we first started. I'm going to start to introduce all the components gradually so you understand how they fit with one another. So the examples that we did with the CVD and also the TTM Squeeze Pro, yes, it is subjective, but there comes a point where a lot of the subjectivity to this is a visual component that we can all agree upon, right? We can definitely agree upon on several of these. So when we're going to add what I call, the support and resistance lines, this is the only component to this that you guys have to pay for if you so choose, and they're called the voodoo lines. So when I'm looking specifically for my target areas, either profit targets or possible areas of interest for an entry, I'm going to introduce the voodoo lines on NQ or ES, right? I've said in the beginning before we started that they are interchangeable. So let's show that here. Let that do its calculation. Just in case you've never heard of the voodoo lines, some of you already have based on other educational content that we've created. This has a hierarchy structure. I'm going to go through it in 20 seconds here. There's red, white, and green lines, the only lines that I like to pay attention to. In the intermediate, there are skyline levels, which are blue. But now that I'm trading this, I want to catch some of the larger moves. The red area are the strongest magnetized area. They are support and resistance. The second most important levels are going to be the tree line levels. And then third to that, tertiary, is going to be the snow line levels. So in between these levels, I'm paying attention for entries. Now, this is really cool. You have to wait for the voodoo line levels to coincide with the hierarchy structure that we talked about for the indicators. Well, what is that going to look like? Moving averages, and then either, if there's volatility in the market, which there is, but how are we going to know? Are we oversold? Are we overbought? Depending on what time frame we're using. And then from there, I know how much volume is behind each of the candles. In the last couple candles there at the end of the day for the last trading session, there was quite a bit of volume there, right? So we have information that's telling us different things, but they're building a story, dude. They really are. So they're telling us, okay, where can I find support and resistance? How much volume is behind this particular candle? I want to know that. Are we oversold or overbought for the time frame that we're looking at? This is just off the 5-minute time frame. Now we're going to zoom out just a tiny little bit, and this is where I think, specifically for me and my psychology, maybe for some of you as well. When we just move out and zoom out of the time frames, when I'm using my voodoo lines, and it's okay if you're not using them. I mean, I understand that not everyone is going to have access to them, but if you are part of the Discord group, just ask us for them. I'm going to give them to you. For sure, I'm going to give them to you because I want you guys to also be successful. Doesn't mean that we're coming into this area and we're going to completely respect that area. Just check out the fire line, right? These were all the examples that we were going over where I was telling you this is where I'm taking my entry. Look at the time frame. Let's jump between the 5 and the 15-minute time frame. It gives you way different perspective on where you can look to take your entries. When you're doing it off the 3-minute or 5-minute time frame, those are 50, maybe 70-point moves. And those are fantastic moves. Don't get me wrong, right? They're definitely fantastic moves there. But when you're jumping into the 15-minute time frame, just check out how much of these moves are actually made when you're looking at it at a larger scale. Now, some of you guys are already, you're running ahead of yourselves, and you're going to get what I'm going to say here in just a second. But you're saying, okay, Sage, so I get the moving averages and I get the TTM, I get that. So what happens when we're looking at the 5 overcoming the 21 on the 15-minute or maybe the 30-minute time frame? That's interesting. Well, it kind of looks like an entry to me. So your stop loss needs to be, it can't be 30 points. Right? That's the only thing. With every trading system out there, there has to be, it's a system. Every system goes through the Venn diagram, and the Venn diagram is as follows. If you want to have a high win rate, you need more signals, and you need to cut certain positions relatively quicker, so on and so forth. If you're looking for larger moves, your stop loss needs to be a little bit bigger. You need to be more lenient on that. So same thing here, right? We're going through the Venn diagram of situations. There is no such thing as a trading system that's going to hit all 3 of the monikers. What are the 3 monikers? The biggest move possible with the highest win rate possible with the best risk reward possible. Those are the 3 most important things in trading, right? All of that is going to be meshed depending on what trading system that you want to use. That's why I keep on saying, and that's why the end, right? Remember when I introduced what we're going to be talking about during these segments, the last thing I said was building your own trading system because everyone's psychology is different. You're not going to be taking the same signals that I am. You can follow the methodology pretty closely, but that doesn't necessarily mean that you're going to fire every trigger that I am. Understand your system, understand where it's weak, where it's strong. In this particular situation, I can point out very clearly where the 5 overcomes the 21 and where I'm taking the position and where I can call it quits. If you are oversizing, which is something that we talked about for an hour recently, not to do that, right? We're not doing 20 contracts on ES or NQ. But if you take 2 to 3 contracts, that's a reasonable position, right? And then from here, you're looking at your risk reward. So come into some of these voodoo line levels. I'm not introducing too many bits and pieces of information. I'm doing it as I promised you. I'm doing so gradually. So I'm coming into these areas. Boom. I'm just looking, is there a point of interest there? Now, notice, we're looking for confluence factors. Confluence means that more than one thing are true or saying the same thing at the same time. So we come into a tree line right here. Am I going to take the tree line long just because it hits the tree line? No, I'm not doing that. But notice something that I think is really interesting. When we're overcoming the 5 and the 21, we did that. We're taking that entry, right? We're taking that entry, and then we're going to use our risk reward calculator here on a long or a short position. Is this a reasonable trade for us to take? Now, when you're using the higher time frames, you can understand what your risk reward actually is. So I'm using my tree line as a point of reference. That's all it is. And then I'm using my snow line also as a point of reference. So here is going to be my profit target. Let's just do the math here real quick. I'm going to solve all your stop loss considerations with this example right now, and I'll give you more than one. If I will take this trade, right, when the 5 is overcoming the 21, if my target area is, it looks like maybe 60 points away from where I took my entry, look at my risk reward calculator. It's 0.08. Is this following along with my methodology? No, it's not. So I have to move up the stop loss. Where's my stop loss going to be if I'm going to adhere to at least a 2-to-1? It's going to be maybe 30, 40 points away from where my entry is. Now, that is a shallow target, right? What I mean by shallow is I'm looking for a very minuscule move. So I'm going to have that as one of my profit-taking areas. I generally recommend that you use 2 to 3. So I have one there, right? You guys generally see when I'm doing anything in Discord, just in case maybe you're watching me for the first time. But generally in the Discord, I have more than one target, right? So my target, I'm not using the skyline right here, but the skylines are going to be little incremental levels between the snow lines and between snow line to tree line to fire line. So there's usually a couple targets, maybe 3 or 4 in between these areas because these are massive gaps. But I'm going to at least, let's just follow the example here, and I'm going to put a target area right there at the snow line. Does everyone see that? So we have target area here and target area there. I'm not going to sit here and say that that would not be my first target area. However, all things considered, little tiny bit of experience that you're bringing to the table. Is that a move that might be seeing more of a move to the upside? Yeah, I think it is. So that is a first profit-taking area. It's a really good example. Nothing that I'm saying, not a single detail of what I'm saying is deterring from the fact, the first half an hour, 35, 40 minutes that we spent together, is deterring from the signal that I taught you to take. The 5 overcoming the 21. It's just a different time frame. Remember what I said, depending on if you zoom in or zoom out, you want to take the same condition every time. That's what I'm doing. I'm not handpicking this signal and saying, hey, if you would have taken it here, you would have caught a 800-point move. That's the stupidest shit ever, right? But what's not stupid is following the conditions of what we're talking about. What was the condition? Condition was us overcoming the 0 line and then hitting that 5 to 21. You have 2 levels of confluence there. And then to add insult to injury, you have a little bit of the CVD, a little bit of it, not all of it. But I'm specifically looking at the moving averages. That's the first thing that I started with, and that's what we're going to use to at least ignite somewhat of our curiosity to fire the signal or not. So we have that here. We definitely have that. Am I going to move the stop loss a little bit further back? If you are going to do that, pay attention to this. If you're going to do that, then your profit taking area or your profit target needs to be moved up because you need to adhere to at least a 2 to 1. So if I'm going to put on that trade approximately there, I'm not going to get it exactly, right? I'm not going to get exactly at 800. I'll probably get in at 810, 820. If I'm going to do that, then make sure that your stop loss, this is going to solve every stop loss problem that you will ever have, every single one. Make sure that you're at least adhering to a 2 to 1. So your 2 to 1 makes your stop loss at about there. So you can say, hey, Sage, that's a 100-point stop loss. That don't make sense. It does make sense. It does make sense because your profit target area is exactly what you have there with your snow line. Now, if you're using a different sort of condition, some of you are going to say, well, I really don't like that target area. I kind of like that target area a little bit better. Then it's even better. Okay, it's even better. Then you have a 3 to 1 risk reward. Do not make your stop loss placement based off of where you see the candle. I don't think that is the right approach. My opinion is going to be, it needs to be based off what your profit target area is. If your profit target area is right here, it's very shallow, then your stop loss needs to be here. The reason why I'm even bringing this up is because if you trade specifically focused on the risk reward and the win rate, right? If your win rate is 2 to 1, then you just need to be right 35, 37% of the time. If this is how you are placing your stop losses, the rest of the data that you have after you take 50, 100 trades will play itself out because you are playing the probabilities as opposed to playing your opinion. Do not take the stop loss because the tree line is right here. If you're going to do that, right, you need to focus on what your profit target area is first. Remember what I said when I was yelling at you guys at? I was saying, don't move the stop loss first, right? Don't move that down. That's ridiculous. You want to first look at your profit taking area. So from there, let's just say it's that. Let's just say I have 2, right? I have 1 there. So if my profit target is roughly that, then I can set my stop loss at a reasonable level right here. If that were to come to pass, I personally would set my stop loss a little bit tighter, and I'm going to explain why in just a second. But if I'm getting a decent enough signal off the 30-minute time frame, I'm not even talking about the 5-minute. You're not going to be getting signals every day, but if you're looking to swing trade or looking to catch some of the larger moves, since you can do this with futures, you can play future. It just closed 1 hour a day, right? You're holding overnight. These are some of those overnight moves that you can catch. And remember, you can set the stop loss that can be stopped for an overnight move. So it's not like shares, right? Where, oh my goodness, now I have to set the stop loss when the market, I got to get out of my position because I'm not trading 23 hours a day. You don't have that problem here with futures. So you take the position. My stop loss is probably going to be, so it's going to be pretty tight. Now, I already have pretty good risk reward here. And this is just one level of target, right? There's several of them. I'm not handpicking the situation. I'm going to share with you situations where, this right now looks like an awesome trade because you would call it an 800-point move or probably more. But we're going to talk about different situations where if that doesn't happen, at least you have that safeguard of using the proper risk reward that I'm talking about here. So I'm going to set it about there. But why would I set it so shallow? That's the question you need to ask. It's just because right here where that 5 is overcoming the 21, that is a critical injunction point. If you are overcoming either on the short or the long, because you got that right here too, right? We're going to talk about that signal here in just a second. If you have that on the 30-minute time frame, you have a higher quality signal. So that higher quality signal, you don't need to focus on, okay, if that overcame and that's showing me a long signal, why the hell would I wait too long in order to be stopped out on that trade? You're going to be stopped out at a relatively reasonable stop loss. You'll take your $200 loss, whatever, and then you'll jump back into that trade as soon as that condition is starting to be hit again. Do you see what I'm saying? So it's okay for you to move from a short to a long position or long to a short. That's okay. Off the 30-minute time frame, generally that's not going to happen that quickly. You might get that situation here. You definitely did. This is a really good example to talk about the prior day. So I'll do that after I get through this example here. There's a lot of examples that I can give you. But you're not moving that stop loss where this number, the ratio is no longer working in your favor. If you're going to do a shallow target, that's okay. There's nothing wrong with that. Just make sure that that's at least adhering to a 2 to 1. So if you have a target that's similar to that, that's okay as well. You just want to be cautious. You want to have 2 inputs on this. If the 5 no longer is overcoming that 21 in the situation where, it jumped above, right? We got a really strong candle there. It looks like this probably would have been a binary event. So you got a really strong candle breakout. That's invalidated as soon as that 5 starts to be degraded. So where would I take this position? I would have taken this position. Let's actually talk about this example right now. I think it really, really fits quite well in this situation. Let's say my target area, I take that position there, and then my target area is that, right? The high of day. And let's zoom into that real quick, so you guys can understand why it's so important, that stop loss and just sticking to this trading plan. Because if you don't stick to it, this is where you screw yourself over. So I'm taking that entry and then I'm setting my stop loss here. As soon as that candle starts to move in my favor, first of all, the way that I'm teaching you, you're already moving that stop loss to break even. That's what you're doing. You might even move it a little bit into profit. So would you be stopped out here on regular break even or maybe in a little bit of profit? You probably would. If you're following along with what I'm teaching you, you will. Okay, you definitely will. Now, how do I know on the 30-minute time frame that is going to flop over like that? You don't. That's why you're trading with the safeguards. So that safeguard is this practice, this principle. So now, can I enter a short in this situation? Yeah, you definitely could. You can enter the short in the situation because off the 30-minute time frame, if you're going to use that, if you're jumping between the 30-minute and then the 5-minute time frame on an intraday spec, then you're going to get signals that are not doing what you need them to do. Why? Because you're overlapping the time frames. If you're going to use the 30-minute time frame, use the 30-minute time frame and stick with that. If you're going to use the 5-minute, stick with the 5-minute. If you're going to use the 15, stick with the 15. The signals are going to be the same. They're all identical, independent of what time frame that you're using. It really is up to you on how much of a move is that you're looking to catch. If you're looking to go out on a fishing boat, depending on the bait and depending on the reel that you're using, it's going to matter. It's going to matter. What kind of fish are you looking for? If you're looking to fish a marlin with a small little rig, that's not going to work. So make sure that the equipment that you're using is applicable to the size of the move that you want to catch. So in this situation, in every situation, I can sit here for 35 hours. I can bring up every single circumstance where, okay, maybe I would have been stopped out here. It's not an egregious loss. It's not a big loss. It's not a large drawdown because you have that control here with futures. So would I have taken a short position? Probably. Maybe. I don't know. Is the squeeze firing there to the downside? I would have taken the long position there. And in fact, I did. I took a long position. I'm speaking from experience because I actually took this trade. But I didn't take the short position. Why didn't I take the short position? That's probably what you should be asking yourself. I didn't take the short position because we were not overextended and we weren't oscillated all the way to the top in order for me to substantiate that short. Does that make sense? So everything that I'm saying now, it lines up perfectly with the last hour or 45 minutes that we spent with the first technical analysis video. So I would be invalidated. And then I would wait for that next signal to come my way. Would that be a signal short right there? Well, depending on how egregious that oscillation is. So if there is a strong move to the upside or strong move to the downside, I just better make sure that those oversold or overbought conditions, those are fitting exactly the entry that I want to take. So did I have a fairly decent signal right here while I was coming off of a bottom? I can argue and say, well, Sage, that doesn't really look like marginally. That doesn't really look like we were oversold by that much. This is the decisionary or the discretionary part of this. So you have to make a decision. Are you going to be taking that 5 or that 21 cross? In this situation, obviously, it looks like it worked out pretty well. I don't know if I would have taken that signal, to be perfectly honest, because we weren't oversold by a large margin. But now we have that tree line. Now that tree line is saying, okay, we held that area. So why wouldn't I try that? Do you see what I'm saying? So it's not that all of them are going to line up perfectly well 100% of the time. If that's what you think that you're learning here, you are sorely mistaken. You're not going to have all 5 or all 10 conditions that you write out in code hitting exactly 100%. And then from there, you fired the best signal in human history. No, that's not going to happen. You have to be able to have enough experience where if you are hitting your first condition, it's the moving averages. That's the number one thing. If you hit that, then everything else, is there enough boxes that are being checked in order for you to fire the signal? In this situation, I think that you had a better quality signal here than you did right here. That's my opinion. Why? Why am I even going to bring that up? Because look at the volume delta. Look how much we bum rushed that move from, it looks like 790 all the way up to where the signal was fired. So we went from 790 all the way up to 940, right? That is a substantial move, but I'm not going to take that signal, not off the 30. I probably would have taken it off the 5 or the 10, but I'm not talking about that time frame. Stick to the time frame that you need or you find the best results. For me right now, that's between the 5-minute or the 30-minute. If I'm looking at the 5-minute time frame, I'm looking to take trades just off the 5-minute. If I want to day trade and I want to do this, I want to take a couple trades throughout the day, that's fine. You can spend time there on the 5-minute or the 10-minute. But if you want to do a little bit more of the larger perspective or some of the larger moves or look to swing some of these positions, I would recommend that you spend time on the 15-minute time frame all the way up to the 30, maybe even 1 hour time frame. On the 1 hour time frame, you're probably not going to get signals for a couple days. You'll probably get a signal maybe 1 or 2 per week, maybe not even that, right? So you got to play with this a little bit. Off of the 30-minute time frame, when I'm looking for those swings or I'm looking for a happy medium between the 1 hour and the 5-minute, 30 seems to work out quite nice. 15 is going to do the same thing. So let's stick with the 30-minute here real quick. In my opinion, you had a stronger signal here. Why am I saying that? I would have been wrong. I'm wrong, right? There's no explosive move here. So you had the volume delta that picked up, and for some reason, market rejected. Did you have that same condition? Check this out. Do you have the same condition there on the TTM? No, you don't, but you do have it on the CVD. Does that make sense? The CVD is telling you, okay, doesn't really look like there was an oversold condition because, of course, we weren't that oversold contingent here upon the TTM. But off of that volume delta, now you see why I like the CVD. Off of that zero line, it looks like it really started to pick up some momentum. And then, in fact, we kind of lined up right there with the CVD, with the TTM starting to fire right here, and that cross. Notice that. Notice exactly where they line up, right? This is not out of opinion. This is out of years and years and years of paying attention to indicators and putting one system on top of another and then back testing and saying, okay, this is what it is that I need to look for. This is what this is all about. So just make sure that if you are using your indicators or you're using any sort of system, that the indicators that you put on the chart, they're lining up with a particular narrative. So do we have the snow line would have said, okay, maybe this is a level that we can see some sort of reaction off of. So the snow line was a little bit late, right? But the snow line is not giving me, it's just giving me a condition. It's not giving me a trigger. The trigger is right there. That is the trigger. The trigger is going to be right here, right? So it's not going to line up 100% every single time. No, of course it's not going to line up. This is where you come in. This is where you make the decision on clicking the button or not. I would have taken that trade. Would I have taken that short position? No, I wouldn't have taken the short position. I personally would have not. Would you have taken the short position right here when we're crossing that 5 and the 21? You might say yes. I'm going to say no. I'm going to give you why. I'm going to say no because right here we're way too shallow on the TTM, right? And we're way too shallow right here on the CVD. So there's no reason for me to take that trade. Now let's talk about this trade right here. Let's talk about some of these long or these short signals. Would you take this long position approximately there where the 5 is overcoming the 21? I think that that's a legitimate signal. I honestly do. So let's put on some circles there and let's see if that lines up here with the TTM. Does it line up? Well, you can say, hey, that oscillation on the TTM there, that wavelength, that looks pretty shallow to me. I don't think I want to take that trade. That's fine. That's fine. But notice that the signal is there, okay? That is there, and then you have a little bit of volume that is starting to pick up pre-market. So you guys can trade pre-market, right? Depending on where you are in the world. That is a legitimate signal. It is nothing different than what I've said for the last hour and 20 minutes. Boom, you have it. Do you have a short signal coming right around here? I would argue that you do. I would honestly say, yep, I think you have a legitimate signal. So would you caught this move here to the downside? Some of you are thinking, I don't know, Sage. Would I have not? Is that a signal there or not? Let's look at it. I'm not going to take the trade up here, right? Because the 5 is not underpinning the 21. So there's no reason to take that trade, right? I would not take this trade, not at all. I'm not going to say, oh, it came up into the snow line and now we're not going to do that. But what I am going to do is I'm going to look at this oscillator. Let's blow that up a little bit more so we can understand the point. Are we in an overbought by a large margin or an oversold condition? No, not that much. Not that much. So when we were starting for the first cross, would I have been indecisive on this trade? Maybe I would. Maybe I would take that trade. But remember, if we're using the stop loss principle, more than likely you would have caught the trade. I didn't catch it myself, but I had my bias. And this is the part of trading that everyone hates because we always have a bias on something. So how does this trade, or how do I know that this would make sense? It's not dependent on the stop loss, but where my profit target is going to be. What would my first profit target be? This is why the voodoo lines are important. This is why I'm spending some time on them right now. If I'm taking that trade and firing on it, and I'm setting my stop loss at about that high candle right there, I would have caught this trade. And when I'm reviewing my positions, right, I did my recent review on this, on why I didn't catch this trade. I'm looking at this and I'm like, yeah, I probably should have signaled that, or probably should have been in that. And that's not conflating anything. That's not trying to find something that's not there. It's there, baby. It's definitely there. So had I set my stop loss accordingly, had I set it, and look at my risk reward ratio, it's 3.75 to 1. This is a perfectly reasonable trade for you to look at on the 30-minute time frame. So this is why I was talking about you looking at two different time frames. So let's recap here. CVD, TTM, we also went over the voodoo lines, and then we talked about the moving averages, right? Not a lot of stuff going on. It's really not that busy. It starts to get busy when you start to overlap these things. So when I'm coming up into this chart, let's put on NQ. Why do you think I have two time frames? I'm looking at two time frames because ideally I'm looking at two strategies. It really is. It's two strategies. So what I have on my chart, excluding the ATR, I'm going to take off the ATR here for just a second. Excluding that, check out what I have on my chart. I have my CVD, I have my TTM Squeeze Pro, I have my voodoo lines, and then I'm just looking on the higher time frame structure. What can I trade? Am I looking to take a trade off of the 5-minute, or am I looking to take a trade off of the 15-minute or 30-minute time frame? If you are looking for some of the larger moves, you're probably going to spend a little bit more time on this side of the chart. If you're looking to do more of the day trading thing, and if you're looking to catch a couple more signals, just be careful. You want to be careful, and you want to use this side of the time frame just so you can understand where the larger structures are. If you want to stick with one or the other, if you want to do the 5-minute time frame thing, then you don't have to have 2 time frames. I'm just going to include this here. This is completely subjective. But if you want to do just strictly the day trading thing, spending time on the 5-minute time frame is perfectly fine. You don't have to have 2 time frames. I like to have 2 time frames just because if I'm looking at a decent or high quality signal that I can designate off the 15-minute or the 30-minute time frame, I want to see if that coincides for me to get a better entry on the shorter time frame. Now, I'm going to share with you how I use this in order to catch seemingly bigger moves in the market. It's not always going to happen. If I'm going to trade the 5-minute, I need to treat it as a 5-minute time frame trade. I can't use the 5-minute time frame and have the expectation of the 30-minute time frame as a trade. That can't happen. If I'm going to use the 30-minute, I want to at least try and see if there's something precise that I can use off the 5-minute in order to pull the trigger on the 30-minute time frame trade. So here we are on the 5-minute. How many signals can we point out? We can do this all day long. We can be here and then we can point out several signals that are crossing on that 5 and that 21, right? We can literally spend hours and hours. We can spend an entire weekend just going over these. So, all right, fine. We got that. Boom. We understand where we're firing the signals. Now off of the 30-minute time frame. This is what we're going to use for context. So how are we going to use this for just deciding whether we're going to be taking a trade or not? You already understand out of the situations that I pointed out, what would be a higher quality signal over a less higher quality signal, or just a signal that you don't want to take. Use your oscillator, use your CVD, and then use that cross. Now let's do the 2 time frame thing. Let's remove the ATR here for just a second. Now, how do I know that we're trading into a desirable pocket? I'm going to remove these averages real quick, and we're just going to stick with the 5 and the 21. So if I'm looking at these signals, obviously, when we're looking at these more shallow candles, you will get more signals in order for you to quote unquote fire on, right? Does that make sense? Now, if we go further back, let's just say we take this day right here. If I'm looking at this and I don't see off of the 30-minute or the 15-minute time frame, this is a 15-minute, we'll use the 30. If I don't see off the 30-minute time frame that we are not at a critical injunction point off of the 5 and the 21, then more than likely on the shorter time frames, I'm just looking to do the shallow day trading thing. But if I want to look to swing something or look to catch a larger move, I'm going to use the 30-minute, whatever 30, let's use the prior day. I think that's going to line up quite well. I'm going to use this and I'm going to say, okay, off of the 30-minute or off the 15-minute time frame, I don't necessarily see where the moving averages are giving me a clear finite signal. I did get one for a short here, that's for sure. And look at that, off the 15-minute, that's a pretty clean signal. It's clean, dude, it's really clean. So I'm saying if I want to take a trade or not take a trade today, this solves another one of the biggest trading problems that exist with all novice traders is taking too many trades. You're taking 30, 40, 50 trades, or maybe not that exaggerated. You're taking 15 trades a day, then use the 15-minute or the 30-minute time frame to put into context whether it's even worth your time or not. If you do that, you'll start to notice that, when people are firing signals left and right, I'm generally not looking to take the trade, or sometimes I do 1 or 2 trades a day. It's because of this. It is literally because I'm using the 2 time frames to put into context. Higher time frame first for me, and then the shorter time frame. Am I jumping back and forth within the 2 time frames? Yeah, of course I am. Of course I am. But I'm using the 15-minute or the 30-minute to give me the better context. Now, I'm just going to share with you what I did last time. I also included the different time frames, the time frame combos of which ones you should use when you're looking to trade this overall strategy, when you're using 2 different time frames. When you're doing very short-term scalping, you can use the 1 and the 5-minute time frame. This is a pretty good combo. This is ultra short-term precision entries. If you're looking to be 100% surgical, this is going to be the time frame that works for you. Now, if you want to play with where it is I'm playing, you're going to be in these 2 boxes. You're going to be here and here. So what I went over, the 5-minute and the 15-minute, depending on where that 5 or the 21 overcomes or underbids, those are the areas that I want to pay attention to. And then I want to look to be just a tiny little bit more precise using the 5-minute time frame. Does that make sense? So if you want to do more of the day trading thing, if you want to, hey, Sage, I don't want to be on the chart all day. I don't want to be on the 5-minute time frame. That's okay. I gave you 2 boxes right here. The one that I would recommend that probably is going to be retrofitted for you guys that are not sitting in front of the computer all day, or if you're working and you're multitasking, the 15-minute to 1 hour is going to work quite well. So if I go into the 1 hour time frame, you guys are going to see on the 1 hour, the signals are even cleaner and clearer. Let's go here and let's go to the 1 hour time frame. So 1 hour right here. What do we got? we know exactly where we need to take the signal and where we need to set the stop loss, right? It's pretty clear, dude. It's pretty clear. You got a signal there, right? You have that oscillation right there on that zero cross line. And let's introduce the CVD as well, because that's very important for this trading methodology. So CVD is there. So that's a signal. I would argue and say that that's close to a signal, but you probably would have taken this one. So that one's pretty clear. You would have taken this short if you're just using, look how clean this chart is, dude. I mean, it's incredibly clean. Probably a signal right there. Yeah, more than likely. That was the signal that we were talking about off the 30-minute time frame that I would fire on. But if you're using the 1 hour, maybe you wouldn't even entertain the idea. Probably wouldn't even entertain it. Here, more than likely, you would have taken the signal. This is the signal that I've recently taken. I took that. I don't know why I didn't take this. I really don't know why. There's something psychologically for whatever reason, right? So I don't like saying, okay, I took that trade, I took it, and if I didn't take the trade, I'm going to say I didn't take the trade. I didn't take this freaking trade. I should have. This would have been a $50,000 trade had I taken it. I know that this is an educational segment, but understand that I also trade the market. And I'm pissed off when I have a trading system that I know that works, that I can identify on, and I don't fire it because the human component, right? Because we make silly decisions and sometimes we don't fire it because of our bias. But I digress, guys. There's the signal. Cool. The signal is very clear. So I don't have to pickpocket here. I don't have to be too specific. Whenever you're looking at any other condition, you're looking at any other time frame, just check out that 5 and that 21. Y'all can back test and reverse engineer everything that I'm telling you. All of that, you very clearly stated, right? Using the stop loss principle, using the risk reward principle, and using the 3, now 4 indicators that you have on your chart, you have a trading system that you can fire consistently on. It doesn't necessarily mean that you're going to win on 10 of the 15 trades that you take or 10 out of 11 trades. No, but you put yourself in a position where you can catch a good size move. Now, let's add just 2 more components and then we'll be done. I promise. So the next component I'm going to ask is that I'm going to add on is going to be the VIX. So I like to look at the VIX just to know if I'm looking to catch the move, is the VIX jumping or is it selling off? The VIX is going to be a stronger component and a stronger correlating relationship with ES. So I am using the VIX with NQ as well, but the VIX is going to be retrofitted quite perfectly to ES. So why do I have it on my chart? It's just an additional layer. It's just an additional layer to confirm, okay, are we selling off on the VIX or are we buying the VIX back up? In that sense, I'm looking at the higher time frame and I'm saying, and let's do this exercise right now. Let's do it for the last trading day. On the VIX, right? VIX right here, and then we have that sell-off right around here. When we started picking up on the VIX, then I saw that this was starting to drop. We had a little bit of a relief right here, but overall, the VIX was being bought up. So the VIX is not going to be a one-to-one relationship. It's not going to say, hey, for every tick that we move up on the VIX, we're moving 1 tick down or 1 point. It doesn't work that way. But if I do want to take a long, if I do want to take a short, I want to see that the VIX is going to be doing the opposite of the directional bias or the signal that I'm getting. Does that make sense? So if I'm looking at the 30-minute time frame, the only recommendation that I'm going to give you is the VIX you need to look at on the 30-minute. If you're going to use the 30-minute, 30-minute. That needs to line up. If you're going to be taking entries off of the 5-minute time frame, if you're going to do that on ES, let's do that real quick. You're going to do 5-minute time frame here. This should be 5-minute time frame as well. Okay? They need to line up. You cannot be taking signals or you cannot be taking a trigger or a target from here, 15-minute time frame, and you're looking at the 1 minute on the VIX. That's going to give you conflicting information. You do not want to do that. And on top of that, this is just another thing. When I'm looking at the cumulative tick, the way that this works, it's just an index. It tells you for the broad-based market, if the majority of the market is either being bought up or if it's being bought down. When I'm looking at all 4 things, this helps me. Maybe it might be information overload for you, but this is going to help me make the trading decision on whether or not I want to go long or whether or not I want to go short. So I use all 4 things in tandem with one another to make that decision. So let's recap, right? Because I went over a lot of information. I want to make sure that you guys understand this. So take a quick time out from here. You can pause the video and then we can recap as soon as we get back. Let's recap on all the things that we've done here thus far. We're running a marathon, and I don't want you to miss out on any of the conditions or any of the little nuggets of information that I'm giving you. So, of course, you guys know the margin requirements now. You know how much buying power you need. You know what a tick is. You know what a point is. You know what tickers that you need to trade, right? We're not doing the minis, but we're doing the micros. Now, on the technical side of this, you know the indicators that I'm using. I'm using the moving averages, the TTM. Once again, I'm using the CVD, but that's not the important part. That's really not what you need to focus on. You need to focus on the risk reward. If you're going to take any trigger, remember, conditions are going to be the indicators, but the trigger is going to say, okay, all of these conditions are being met, and now I'm firing for XYZ reason. It doesn't matter what system you're using. This is the whole point of this. It's not about this particular system or maybe a system that you're using. If you're not consistently firing on what the trigger actually is, then there's no way that you can possibly be consistent. There's just no mathematical way that it's not conceivable. So use the risk reward calculator. If you're not using that, don't just listen to me tell you to use the risk reward. I'm using it on every trade that I take because I want to visually see, okay, if I take it to this point, then I know how to manage that stop loss. We didn't talk so much about it, and we're going to jump more into it because I'm going to tell you how to actually manage the trade here in just a bit. But you put on the trade and you have all those conditions being met. The risk reward calculator tells you, how much risk can I actually look to maybe incur here, or where can I move my stop loss? If you go through the examples that we just went through, you don't have to really worry so much about what the stop loss needs to be. It doesn't have to be a static 30, 40, 50 points. It can be sometimes 100 points. But if you're looking for a 400-point gain, then risk reward is pretty good, right? 4-1, still there. Now, the other component to this is just how much risk you put on. If you're doing 25 contracts, then you probably got a lot of risk on, right? You saw me in some of my examples, or ones that we did prior to going into the technical analysis segment. I showed you three contracts. That's fine. Doesn't need to be more than that. If you want to be overzealous about it, maybe 5 contracts if you have a little bit of a bigger account. But you smaller traders, stick to 1 to 2. That's fine. 1 to 2 contracts and you'll be fine. Cool. And then you build up from there, get proof of concept. And then you start moving up on your contract size. I would move up incrementally by 1 contract and I wouldn't overdo it. What else did we go over? We went over not just the risk reward calculator, stop loss placement, but the conditions that need to be met. What are they? Let's review them one more time. The moving averages, the 5 and the 21. If you want to use the 8 and the 21, the 9 and the 21, 13, 21, that's fine. I would just recommend that you are immovable on the 21-day moving average, because that is a very important one. Statistically speaking, also a lot of data to back this up, but the 21-day moving average is the most significant moving average pretty much for any day trading system out there. It is incredibly significant. It gives you a happy medium between the short-term volatile movements and some of the elongated moving averages. It's really almost perfect. So use the 21, whatever other condition that you want to have, whatever cross that you're looking for, the 2-day, the 3-day, 4-day, 5-day, 6-day, just backtest it and see which one statistically has the edge that you're looking for. On top of that, some sort of oscillator. It doesn't have to be TTM. It can be any oscillator that you're looking at. MACD, RSI, that's all good. Just make sure that those signals line up. If the MACD is telling you to buy here, but the moving averages is telling you to buy here, try to make those two coincide with one another, where they're giving you the same signal at the same time. All right, that's a very important thing that you need to recognize. If you don't have those indicators on your chart that are almost telling you the same thing at the same time, then you don't have a strong system. You just don't. Next, on top of that, we use the CVD. So the CVD is telling me, okay, if I'm getting a signal, either long or short, how much volume is behind it? I want to know if there is good volume behind it or not, because volume moves the market, right? That imbalance in volume. So if I have that off of the 30-minute time frame and I see the CVD is skyrocketing or selling off, then I have probably a good trading opportunity that I want to fire on, right? So cool. We have all that. And then I introduce the voodoo lines. So really 4, maybe 5 conditions, including our discretionary input, that you need in order for you to start trading this at a higher level. Now, on top of that, I introduced 2 other market barometers. The barometers being the volatility index. So if you have the volatility index selling off, usually that gives me confidence and indication that I want to be taking a long position, provided all those other conditions are being met first. That's important for me to outline here. So if the VIX is selling off, but all those other conditions are not lining up, I'm not at a moving average cross, or I don't have the CVD in my favor, or I'm pretty flat on my TTM, then just because the VIX is selling off doesn't necessarily mean that I'm firing on a trigger. Does that make sense? And the cumulative tick is just going to be that last little condition that I want to be met on top of the VIX. So the VIX and then the tick. Those 2 things, if they coincide with one another, all of that is going to be at the bottom of the decision-making process. But those moving averages, the moving averages, and more particularly the CVD and the TTM, those 3 things line up, and then I have those 2 additional layers of confirmation, then maybe I want to fire a long or a short, okay? So this way I'm not taking maybe 7 trades on that day. Maybe I'll do 2 or 3. But if you do that, sometimes that trade that didn't have those conditions is the trade that was the banger, not the banger. Think about that mathematically speaking the next time that you're looking to not take the signal because of your bias. Had I done that, had I followed my system, I would have caught almost an 800-point move to the downside because the conditions were pretty much met, as I've proven to you thus far. Welcome back here to the trading floor. I've taken the liberty, just using the 5 and 21 cross, on just outlining where it is that we might see a signal. So it's worth mentioning. If you're going to be using a 20, 30-point stop loss, generally speaking, on the higher time frames, this is where backtesting needs to be very individual to a time frame. It's not just about backtesting the 5 and the 21, 8 and 21. It's not just about the strategy itself, but also the time frame. Now, the time frame, you need to adjust the stop loss according to what your target area needs to be. This is very important to outline because these are part of the 3 exercises that I would like to leave with you that I'm doing myself. You cannot expect to know how to bench press or know how to do any sort of exercise in the gym and not actually do the exercise. That's not going to benefit you at all. What will benefit you is every day, for 15, 30 minutes. If you actually do what I'm telling you, you will improve as a trader. You're going to take and you're going to reverse engineer and look, okay, so there was a cross here. There's a signal that I could have clearly taken off the 30. If you're going to use a 10-minute time frame, do it that coincides with the time frame that you're using specifically for your trading sessions. So I have one there, I have one there, I have one there, there. Use the risk reward calculator. This is an exercise in and of itself. So if I'm taking right here, if I'm taking the touch, right? I'm taking that and I'm using this right here. more than likely signal is coming about there, about 9:30. Let's say 9:30. Fine, let's do 9:30. And I'm setting a 50-point stop loss. Would I have caught this trade here to the downside? More than likely I would have, right? And I don't want to use this specific example because that's not going to be, it's not good practice. What's good practice is seeing where the system is weakest, right? Because if you know the weakest part of the system, then you know that it usually is not going to get worse than that. So that is the targeting area there. What is that? It's a 5.75 to 1. Pretty good. What about here? Would I have taken that? That is my entry. That is approximately my entry at 100, right? 20, 100. Would I be wicked out? It kind of looks like I would have been close, right? I would have been 20 points away, but look at what my stop loss is, right? If you're picky about, or not just picky, that's not the right word. If you're a very anxious or nervous trader and you don't like to see drawdown whatsoever, if you put into perspective using the risk reward calculator, then everything else falls into place. What you can't do is you can't take 5-minute expectations and then impose that on a 30-minute time frame. You cannot do that. Because if you're doing 10 point, 15 point, 20 point stop loss on the 3-minute time frame, you cannot use that on the higher time frames because you will be stopped out 9 times out of 10. So 50 points is what works for me. If 60 points is what works for you, where you're going to be less nervous is when you size down. You have to find the happy medium. How much money can you look to lose that would make you feel uncomfortable? And how much money, if you do take just one contract, what is that drawdown that you can realistically and physically tolerate, right? Literally, physically, mentally, how much can you tolerate? If that number for you is $1,000, then it's $1,000. Do the reverse engineering to understand. If I have a drawdown of 50 points and I'm taking 3 contracts, what does that mean to me? Sage is telling me to trade 3 to 5 trades. So if I lose 3 to 5 trades in a row, am I losing $5,000 or am I losing that $1,000 that I can tolerate for the day? I know what my tolerance is about $2,000. Anything more than that, then I'm done for the day. Okay. So let's go back here. Would I have been stopped out on this particular position? No, it doesn't look like I would. And that's a 50-point stop, right? If I would have taken this trade, I would have taken that trade off right there, right when that 5 is now starting to peak right there at the 21. So how much of that move would have been caught? I actually, 335 points. Wow, that's a great move. Let's talk about a couple of other short positions. I'm trying to look for the shorts and then I'll go for the longs. Here, if that 5 is underpinning the 21, would I be wicked out there? No, I wouldn't. Let's see if I can find a scenario where I would be wicked out. Short position here. Okay, that's one. Maybe I would have been wicked out here. I don't think necessarily I would. I don't see a wick that is hitting the 50 point stop. Let's see what else. Let's go back here. What I'm doing right now, this exercise is reverse engineering. Reverse engineering my strategy to see if it would. I don't think I would be hit there either. So great, fine. This is where I constantly say, be careful with your bias. Try not to have 100% a bias when you come into the trading floor. Let's do this exercise on the longs. Just spending a little bit of time so you understand what reverse engineering is. Reverse engineering doesn't mean that you have to code. You don't have to code. I mean, you do if you're backtesting, but you don't have to be overly scientific about this. You don't even have to spend more than 30 minutes at the end of the trading session. Just doing this every single day, you're starting to build up endurance and you're starting to see, okay, what is noise, what is not noise? Pretty decent signal here. Would you have been stopped out? Not even close. You would have not even been close to being stopped out. What about that signal? Do we have a signal there? We don't. What about here? Would I have been stopped out? No, I wouldn't have. What about here? Is there a stop out? I don't think that there's a clear enough signal. I think the signal was clearer here. So that's a mistake on my part. Did you see what I'm saying? There's no clear signal there. The signal is here, and I would argue and say that there's not even a signal there because this one was cleaner and clearer. So forget that. Let's take that off. All right, what about here? I wouldn't have been stopped out there, right? I'm looking at the 30-minute time frame. How many signals am I getting? How many trading sessions are there? 1, 2, 3, 4, 5, 6. Remember that you can trade after hours, right? So some of these they're looking like good signals after hours. There's a lot of movement that happens on the indexes. So if you're writing just a simple snippet of code and then you put it in trading view and then you get an alert, okay, I'm getting a 5 and 21 cross. See what I'm saying? You don't have to sit in front of the computer all day. You're not going to get every single signal for every single open session. No, that's not going to happen. If you want that, then you're going to look at the 15-minute time frame or the 10-minute time frame. So cool. That's one exercise. The next exercise, this is a very obvious one. I'm sorry I keep on bringing it up, but it is important, is just using this. Just using that. The more you use this and the better you can get at just looking at something and determining, is it even worth my time? This is going to benefit you in the long run. And then the third exercise that I'm going to say is a combination of either paper trading or just looking at something and seeing if it's going to play in your favor. It's a mental trade. I've been doing this a little bit more myself, but taking a mental trade is just basically marking up the chart and saying, okay, I would take this trade here and let's see how that's going to play out. You can do this on any time frame. So a mental trade, I like to write them down. I'm going to say just like I would with any other trade, but I separate it. And paper trading is going to work the same way. It is exactly the same thing. if I do take a trade here, where's my stop loss? And would this trade have worked out or not? You do this enough times. I'm looking to do this about 1,000 times. So if I'm looking for 3 to 5 trades a day, then I know how long it's going to take me. If I can do that 1,000 times over, then I know what to look for, and I know that what I'm doing is working a little bit better. So I've taken several mental trades already. Generally with my mental trades, I'm taking an actual trade. So I kind of use both examples quite well with one another. I brushed up on my own futures trading and my own, I've been trading for a while, so I can pull the trigger and I can acclimate myself a little bit quicker. But for you newer guys, the mental trading thing, the mental trade that you would take and say, all right, let's just see how this works, but actually mark it up and then taking a screenshot and understanding and reverse engineering. Okay, this worked. I mean, this really worked, or it didn't work, but I would have done the correct thing without being emotional. Those are 2 exercises that I'm going to recommend you guys do constantly. Cool. All right. So we're coming and we're concluding on these sessions. Right now, I think we have a very good picture of what futures trading is all about. Are you going to learn every little thing and every little detail from just the examples that I gave you? No, there's a lot to do, and there's different tickers to look at, right? There's a whole bunch of different things that y'all need to consider. So going forward, if you're going to do back testing, if you're going to do forward testing, that's a really good exercise. So that's exercise number 1, back testing. Exercise number 2 is going to be using the risk reward calculator. That in and of itself is a really good exercise. And then exercise number 3 is going to be reverse engineering. Think about all the things that we talked about thus far. Think about the indicators and then see if you can tweak it, right? I'm really interested to hear your guys' feedback on, hey, Sage, I found that this does a little bit better on the back testing, or this does a little bit. That's going to be phenomenal, because that means that you guys are participating not just in taking a trade, but actively looking for something that might benefit you and might make you a little bit more focused on the engineering side of this as opposed to the discretionary side, which is more emotionally based. You have all the statistics and you have all the back testing behind you, then it's very easy for you to make decisions overall. We've come a long way so far. We've talked extensively about technical analysis, and I hope that I've done a good enough job in for you understanding exactly how you build a trading system overall. Because remember, when we first started, the whole end goal is about you building a trading system that you can pretty much explain to someone else, and you can understand, okay, I see why it works, or I see why it doesn't work. And then from there, look at your data, look at your back testing, look at some of the habits that you're forming, and then decide, where do I need to tweak the system? Do I need to do this a little bit differently? Where can I improve? That's constantly what a trader's job is. What I want to dive deep into, maybe I've done this already a little bit with the last 2 hours of us talking about technical analysis, but I really do think that the most important skill is managing a stop loss. You need to know not only where to put it, right? There's an art to that, semi-art to that, but there's also a mindset, little trick that I use for myself that I would like to teach you guys. It's not just always about the placement, but about moving it, right? We never move it in the opposite direction. We're never moving away from our entry point. That's not going to be clever for us to do. What is clever is us moving up and then definitively taking off as much risk as we can. So if you have a $50 stop loss and all of a sudden it moves 5-10 points in your favor, why not move that up just a tiny little bit? So I'm going to give you a couple examples, right? I wouldn't skip this part of the video because I think that this is the most important component to any risk management whatsoever. Me as a trader, me as an educator, I'm always going to profess the fact that you need to worry more about the risk than you do about the reward. The reward will take care of itself if you are strategizing correctly. What will not take care of itself is if you're making $1 million, but all of a sudden you don't have stop losses because now you're ego trading, right? Ego trading has everything to do with you not planning out your trade, you not using the right stop losses because you want not to limit your upside, because sometimes it happens. You go for a liquidity grab lower or higher, you get stopped out by one silly wick, and then all of a sudden the trade starts going in your favor. It's better to be wicked out of that trade rather than see how low you can go or how high you can go if you don't have the stop loss. What's preventing you from jumping back into the trade? Nothing wrong with that either, okay? So I'm going to give you a couple of examples. We'll talk about this, and I'll give you, I would say, a couple of mindsets that you need to have in order for you to be masterful with your stop loss. Without any further ado, let's begin. Hey guys, welcome back here to the trade floor. So I'm not just going to give you one example. I'm going to give you a multitude of different examples. I'm not cherry picking the chart. Chart is the chart. I'm going to share with you circumstances where it's going to work very well, the stop loss placement, and where it's not going to work very well. Where I am now in my trading, I don't think about how much money I can make. I don't think about the $4, $5, $10, $20, $50,000 day any longer. I think about how much can I lose if I am not thinking about stop loss placement when I take a position, especially if it's a larger position. So I'm going to run a little bit of the gamut here. I'm going to talk specifically about my experiences, but more than likely, I've made every mistake in the book that you guys have made plenty times over. let's use this particular scenario. Let's just go on ES, right? I'm not cherry picking. You can pick out any chart and I'm going to explain it the same exact way. For me, even before we begin, I'm using 40 to 50 point stops. The reason why is I know, mathematically speaking, I don't want to be over leveraged. I don't want to be taking, just hypothetically speaking, I have a $100,000 account and taking 50,000 buying power worth of my portfolio to put on a position just to catch 5, maybe 10 points. I don't want to do that because psychologically speaking, when I take the 10 point or 5 point stop loss on ES, it's a pretty big stop, right? You're getting stopped out maybe $2, $3, $4,000 per trade. So if you don't have your OCO order lined up in a way where psychologically speaking, per contract, if you're doing one contract on the micro, you're losing $50, that's not that big of a deal. But if you're doing that with 3 of the larger contracts, 3 minis, think about how much that is. Every stop for me is going to be $1,500, right? Because it's a multiple. The first one, $500. And if I'm doing 3 contracts, $1,500. What happens if I'm taking a trade, right? This is a very common scenario, especially for newer traders, where I have such a strong bias and then I'm jumping into the trade over and over and over again because it's going to go, right? It's going to go. But you're too shallow on where you set your stop loss. The stop loss is 5 points, 10 points. Or on NQ, we'll get to that example here in a bit because incrementally speaking, ES is tighter than NQ. You set it at 10 points on NQ and then you constantly are being wicked out and you've taken already, start of the day, you're in 10 trades already, right? We don't want to do that. We want to take 3 to 5 trades and that's it. So if you're having the problem where you're getting false starts, right? And you're getting stopped out too much, actually go a little bit lower on the stop loss or a little bit higher if you're taking a short position. If you're taking the correct entries, this will take care of itself. All right. That's just my introduction. I didn't even start showing you the chart, but let's dive into these examples. So I have this one chart. We already know that I'm looking for the CVD. I'm looking for the TTM squeeze, and I'm also looking for the 5 overcoming right now, the 21. So the 21 is going to be this rose color. And then we also have the 5, just so you guys know which one is which. So this is my entry. I'm going to take that here. If you're going to be using a broker that's quick, right, where you can set up your hotkeys, and your hotkeys is literally 1 or 2 buttons for you to take the position, that's going to be advantageous for the system. If you have to go into the broker and it's taking you less than or more than half a second in order for you to set up your order, then the system probably is not going to work for you. You need to be quick. You really, really need to be quick. First of all, so you can pretty much pinpoint the entry. But not just that, that stop loss order needs to already be initiated even before you take the trade. If that is not the case, you need to figure that out because the system will not work. It will not work if you have to put the stop loss after the fact. Cool. So what am I going to do with my stop loss here? I got in at 57.45 in this hypothetical scenario. If you want to go too tight, let's just say you want to do a 3-point stop loss. Check this out. In this situation, you wouldn't have been stopped out. But any other situation where you're in a choppy market or price action just seemingly is not going in your favor, you will be stopped out very, very quickly. Just check out some of these wicks, right? We call them rogue wicks. Some of these wicks, just by touching that, boom, you're out. And then all of a sudden, what happens? You start moving in your overall bias because the moving averages are telling you off of the 5-minute time frame, hey, we have some directional bias here. My TTM is squeezing in the up direction or the down direction. We'll talk about the short position here in a little bit. All of a sudden, you just made a clinical mistake. The mistake is the stop loss being too tight. But then you're thinking to yourself, Sage, if my stop loss is a little bit, if it's too wide, then I'm going to lose more money. Okay, how do you fix that? Don't take too big of a position. Take a smaller position. Because if you downsize on your position overall, yes, you're also limiting your upside. But what happens if you catch a riff? What happens if you catch, instead of a 5-point move, you catch something like a 20-point move? See what I'm saying? So remember those exercises that we talked about. We spent almost an hour and a half talking about the risk-reward calculator. Let's bring that up here, right? Because it has everything to do with this. Take on your long position. Let's just say my target is the top of that wick, right? Let's not exaggerate. What does my stop loss need to be in order for me to get to 2 to 1? Well, if I'm using the exercise that we just spent 45 minutes discussing, then my stop loss doesn't need to be that tight. It's going to be determined by what my profit target area is, right? Or what my TP is. Make sure that you understand that calculation. So my entry is, let's say 57.45. How far away am I from where my stop loss target needs to be? I'm about 5 points. Okay, I'm about 5 points. So what happens? What is the right etiquette for when you take a trade? What you need to do as soon as that trade starts going in your favor. I'm going to tell you now that when I take a position, especially when I start seeing maybe a 5-point move in my direction overall, what I'm going to do is I'm going to take my stop loss and I'm going to ease the risk overall. Now, there's a little bit of an art to this. I can't say that this is something that you can compute. This is why the discretionary part of trading is still so abundant, right? It's very hard to code this. It's very hard for you to be mathematically precise on how you need to trail that stop loss. You can trail it by 5, maybe 10 points. Some of you, when we're looking at the shorter time frames, you get very skittish and you get very emotional when you're in that position. I like to at least get to break even. So I'm going to share with you because I actually did take this trade, right? So it's not just an example. I moved my stop loss to break even here. What happened? Do you see that rogue wick? I got stopped out on that wick. How annoying is that? So don't be too quick, especially on your moving averages, right? This is going to only come with experience. I'm not going to sit here on this training session and tell you, hey, it's going to work out every single time you take this setup. All you have to do is move up the stop loss by 2 or 3 points, and then you go from there. That's not the right way to educate you guys on this. The right way to educate you is if you start getting a move overall, by your discretion, the only thing that you're responsible for, literally the only thing, is at least minimizing as much as you can the risk. Are you going to be choking up your stop loss as soon as you're moving and then you get wicked out maybe here? Maybe not even that. Maybe you're moving it all the way up to the 5-day moving average and then you get wicked out on that particular candle. Now, congratulations, you caught a move from here all the way up to there. That's fine. To each their own. You're going to have to decide how it is that you want to trail up your stop loss. We use something called the ATR trailing stop loss. Now, this is something that I'm going to introduce. I told you guys that I was going to do this in the beginning of the training session. So the ATR trailing stop loss is this right here. What it's going to tell you is it's just going to give you somewhat of an indication on where you can move your stop loss overall. You can fiddle with this. You can move a little bit of the multiplier. You can go into the settings. I'm going to do that right now. And you can change what you think the multiplier needs to be. So here are your inputs. If you want it to be a little bit less, then you're going to see how the ATR moves, right? So you guys can use this as almost a barometer of where you should be moving that stop loss, right? You can do this on a few mental exercises. You don't have to do it on your first, second, or third trade. You're not going to get it right. You're not going to get it right after 50 trades. It's not, if you don't have experience, you're not going to get it right. Not even after 50 trades. But the ATR trailing stop loss, if you are doing automation, this tends to do quite well on a little bit of the larger time frames. The only thing that it is, if anyone tells you different, I think that this is incorrect. That's more subjective. It's more my opinion. But if anyone says the ATR trailing stop loss, if you're using that, that is always going to benefit you, I don't necessarily agree. Mathematically speaking, it gives you a good guideline of where it is you need to trail up your stop loss, provided that you are moving overall with the candles. So let's just say I'm moving, right? Let's say I'm moving my stop loss as price action is going. That red area is where I would have been stopped out. How much am I giving up from that wick, all the way from the top, all the way to where we are here? About 15 points. You will never, ever catch the entire move. Your responsibility as a trader is catching a snippet of the move, not the entire move. If you are under the impression that any trader out there will give you the entire move from bottom to top, I think you're hopelessly misguided. Your entire responsibility is just for you to catch snippets here and there and manage your stop loss accordingly. So if you're going to use the ATR trailing stop loss as a guideline, that is fine. I use it as a guideline myself. I would have trailed just a tiny little bit higher. The way that I usually trail my stop loss is using the 21 EMA as my guideline. So long as we are holding above the 21 EMA, the way that I'm moving up my particular stop loss, and this is what I want to share with you guys, is let's just remove the ATR trailing stop loss, right? If I'm going to be moving up my stop loss, I would have been stopped out just a little bit higher. So I'm using that as my North Star. I'm using that and saying, okay, so long as I'm holding the 21 EMA, then I think I have a trade that is worth holding on to. Now, in very many circumstances, you're going to say, okay, I got stopped out, and then all of a sudden there's a huge move that went to the upside. That's going to happen. It's just part of trading. If you want to trail just a little bit under the 21 EMA, because sometimes you get a rogue wick just like that, that's okay as well. I'm not looking to trail very aggressively when I get into a position. If I get stopped out on, a 5-point position on NQ, it is what it is. Or ES in this example, it's 5 points. So what does 5 points mean for someone like me? Well, if I'm not going too heavy on any contracts, then I know I might be losing $50, $100, $150, but I have 3 or 4 other tries, right? There's always plenty of other trades. I am not going to advocate for us complaining about hitting stop losses if they are at reasonable targets or getting it break even. If you take 4, 5, 10, 25, 100 break even trades a day, you've had, I would consider, you may disagree with me on this, but you have a successful trading day. You're going to spend $150 on fees, right? That's what that's going to be like. And maybe you're on the shorter time frames and you're a little bit skittish on your positions, but break even is a good outcome. It really is. Even small trades, right? Even small trades. If you're looking overall for the entirety of your trading sessions after 50, 100 trades, those small little losses, sometimes they're overshadowed by some of the gains that you'll catch. So in this situation, how many points would I have caught if I followed the system that I'm recommending to you guys? I would have caught maybe about a 20, 21 point move. Cool. So now let's take all of that. Let's take all of that thought process. Let's take that methodology and apply it here to a short position. So let's use the risk reward calculator, which we're always going to do. And let's take that, right? So now my stop loss is where my entry is. So let's say the stop loss is right here. Let's conform to that 5-point idea. So we're here, we're about there. All right. So I have a breakup structure, and then I have the 5 and the 21 cross here lower. Had I applied what I'm telling you guys, had I applied the methodology of following the 21 EMA, would I have been stopped out close to break even? No, I wouldn't have been stopped out close to break even. I would have been stopped out right there where the 21 EMA is. Let me clear up the chart a little bit so you guys can see. Let me remove the 5. So that 21 right here, I would have been stopped out. So How much money am I making on this position? It's a shallow position, right? I'm not really catching a huge move. So I made on this position maybe 5 points. What did I give up, right? I gave up, looks like quite a bit of the move, right? 13 points there, a little bit less than that. So it's really up to you. It's really, really up to you. Are you looking to read price action as it happens? Are you going to trail the stop loss back down here because you see a candle no longer moving in your direction? In this situation, I wouldn't have done that because my squeeze is still firing here to the downside. I'm going to bring that up, right? Of course, I'm going to bring that up. But I think it is a really, really good rule of thumb for you to always follow the 21 EMA, right? Always, right? I mentioned this a couple of minutes ago about statistically speaking, it is probably the most close to being the perfect EMA as you can get. So it's the 21, right? Or whatever moving average, the simple moving averages or the exponential. So that 21, if you're looking to catch a little bit of the larger moves. On the shallow moves, yeah, it might suck, right? It might suck to get stopped out. It might suck to maybe hit break even or just get a tiny little win. I'm okay with that because I know that when it's time for me to catch a little bit of a bigger trade, the EMAs are really going to help me out. So what would be a bigger trade? Let's just say right here, let's remove that. In this scenario, I took a 5-point win. Let's just say that hypothetically speaking. Do I have a cross on the 5 and the 21 here? Let's introduce the 5 again. I want to go real slow with these examples because I want you guys to visually see them, right? So that's something else. Let's go here to the 5. Okay, so what do we have? Do we have a 5 touching here? Well, you might say, okay, I might have that signal, but Sage, by the way you're teaching, I don't really see that oversold pendulum here, so maybe I wouldn't have taken that trade. I agree with that. I totally agree with that. It's following my methodology. Let's go back down here. So now I have a cross. Coincidentally, I did take this trade. So for me, we were crossing the 0 line. I got in, let's say, at 57.47. I'm telling you, I'm going to give you several examples. So let's move that there. My stop loss is going to be right here, probably about 5 points away. Let's remove this red line. Okay, you're gone. And how many points would I have caught if I'm looking to follow through right here on the 21-day moving average, using that as my guiding, as my guide? I'm probably looking to catch, let's see, I entered here. And then when I broke below my 21 EMA, I got in right about there, right? So maybe I caught 3, maybe 4 points. Is that interesting? No, of course it's not interesting. What about here? Let's say I took that trade, right? Because we're selling off on an oversold environment. Let's take that entry. Let's put that right there. You're not going to catch the top. That's not going to happen, right? When you catch a good size move, then everyone's going to say, oh my goodness, this system is wonderful. This thing works 100% of the time. No, it doesn't work 100%. It does very well when we have a market that is trending either up or down. Where it's not going to work very well is when we have choppy markets. I don't think any system works incredibly well, aside from being an option seller, where choppy markets are going to benefit you, right? So there's my piece on that. So I take my entry here. I have that 5-point stop loss, which I'm using just as a suggestion. So if I'm going to retrace back up to the 21 EMA, let's just say this is, right, because this is after hours. Where would I have been stopped out on this position? So now you guys are starting to put the pieces together. I'm taking that trade and I'm trailing the stop loss up until where the 21 EMA is. Where would I have been stopped out on that trade? I would have been stopped out here. How many points am I catching on this position? Doesn't matter that it's after hours. It really doesn't matter because you can still trade after hours with futures. So let's calculate that. Let's say we take that position and then we go all the way back down here. That's a 20-point move. Okay, 20 points, not that bad for ES, right? You're making a little bit of money there. 3 contracts, you trail it out, and you're using the 21 EMA. So long as we don't cross that, then it seems pretty good. What is the ATR? What is the ATR going to tell you about this? Are you going to get better results with the ATR? It seems like if you were to have taken the recommendation for the ATR, probably you would have been stopped out. Maybe here, maybe even here. That could have been, right? So that's why I like the 21 EMA just as my reference. My reference is always going to be that. That's what I found that is working a little bit better for me, especially when I'm looking to catch more of the move to the downside or to the upside. Cool. Let's go over more examples, right? I know I'm being very granular here, but I want to be. I really, really want to be because I want to give you guys examples where I get it. It makes sense. It's clicking for me and I can see where this would work. Not in every situation, right? Some of you are constantly thinking, well, I don't really see the same pattern. There's no such thing. Nothing ever happens twice in this universe. It's never going to be identical. But patterns and things that we recognize, they rhyme, right? They definitely rhyme. So if you can learn to recognize the signs and you can do it early on and you're doing what it is that I'm telling you about stop loss placement, you're going to be fine. You're going to be very, very fine. You're just never going to move the stop loss away from what your entry was, right? Because now you're messing with your risk reward. So let's do more examples. If you want to skip through this part, that's fine, but I wouldn't recommend that you do that. Let's use this trend day. Let's remove the ATR, and let's see if with my system, I would have caught this or not. So we're looking at the 5 and the 21 cross. If you want to create an indicator where the cross is going to send you an alert there with TV, that's okay, right? I'm doing that, and that's what I'm doing, right? So I have the cross right here. I'm looking at the 200-day moving average, which is the white that you're seeing. So we have a lot of indecision right here. We have a lot of what's going on, what's happening. So where is the trigger on this trade? Let's zoom in just a little bit better. And this is the example that I wanted to give you. No, you're not going to make a lot of money in a choppy situation where price action is pretty shallow. No, you're not. I don't think anything does quite well unless you're doing iron condors, right? So we do that. Yeah, we definitely do that. But when you're looking to day trade or maybe look at the higher time frames, check out the 5-minute. Where is the cross? The cross is right here. So let's highlight that. Let's just say I want to take that close to market open. There's a lot of crosses going on here. There's a lot of squeezes going on here. How do you know that you're going to be selling off that hard? You have no idea. You have no clue. So would you fire on that signal because you're not oversold in this environment? That's very possible, right? I'm not going to say, hey, look at this move here to the downside. You would have caught this move if you're using my system because I just said my oscillator is not oversold, right? Let's blow that up a little bit. So maybe a lot of us would not take that signal. Maybe we would have taken the signal a little bit closer to here. That's a possibility, right? So maybe not take that entry, but maybe I'll take that one. So how many points am I doing as my stop loss on NQ? Provided that we are literally following to the T what it is that I'm teaching you. Let's say I take that entry. I think that is a perfectly reasonable entry. Let's put on the risk reward calculator. Let's do the short. Let's see what that looks like. And let's do 50 points. So 50 points would be that. My target would be the previous day's support area. So that's the support. But what would I do? How would I trail the stop loss? Or how would I move with the stop? How would I be moving with the stop loss? That's the question that you should be asking. And this is a very interesting scenario. So my stop is here, dude. That's where it is. That's my entry. Let's make that green. And how would I apply the right stop loss management on this position? Well, Sage, you just kind of taught us, didn't you? So we move a little bit in the green. So now I'm moving to break even. Do I have a reason to keep on trailing that position if we are not even coming close to the 21 EMA? I would say probably not. Would some of you be tagged right here? Yeah, I think some of us would be. Some of us we're going to be trying to lock in as much profit as possible. So I'll set that there. So how many points am I already catching? Let me remove this entry. How many points am I catching using my system on a move from here all the way back down to here? I'm catching, holy crap, 150 points from here. 150 point move on NQ is phenomenal. Now, let's just say I'm not tagged on that because I didn't really come close with my 5 overcoming my 21. The candle got close. Fine. You want to use the candle. If you want to use the 5 to 21 cross, all good. If you just want to statically use the 21, that's all good too. I mean, whatever floats your boat. So let's just say realistically, let's say that would be my other area that probably run into some trouble. I'm good with my trade there, Sage, and I kind of get what you're saying. I understand what you're saying, but let's see what this point system is all about. So I'm hitting my 21 right there. Or actually, let's pull that back. I said this area, so we'll do them incrementally. Let's just say I sell off and then I'm coming back into this area. I get a little bit nervous. That's a 270 point move to the downside. And then we have that. That's approximately a 340 point move to the downside with the entry that I taught you for 2 hours now and with what I'm telling you about the stop loss placement. So how would you trail the stop loss? You can do this actively, which is okay, or you can use some sort of indicator. If you want to program an indicator where you say, hey, the stop loss is right when we touch the 21 EMA, now you're starting to become very clever. If you have the ability, I'm giving you so many undertones with my example. If you have the ability to code a trailing stop loss where the 21 EMA is going to be, if you tag that with your candle, then you're out of the position. Realistically speaking, you don't have to make any emotional decisions. That emotional decision would have been out of the game here, and you would have been tagged at maybe about a 340 point move to the downside. That's it. Are you going to catch this entire move here? No, you are not. You are not going to do that. So what we're talking about is you putting yourself in a circumstance or in a situation where, yeah, okay, this looks pretty good. This is a good position that I'm in, right? You don't know it's going to be a good position, but now that you understand the mechanics, this is important. You understand the mechanics of how to operate a trade when you're in one, then you can manage the trade pretty successfully. Did we talk about opinions? No, I didn't have an opinion going into this trading day, right? Or I don't have many opinions when I go into any trading session. It's all about, is it lining up and do I see it? Do I not see it? What's going on here? Now let's go to the previous day, right? This is a good example of a trend day lower. Now let's do a shallow day. Let's do this on RTY, right? I really don't want to cherry pick this. I didn't even prepare for this. I didn't practice for this. Let's just go here to RTY. Let's put that into perspective. Let's go here. This is a nice shallow day. So RTY, what are we following with my system overall? Let's just say you don't want to trade RTY, but it's going to follow the example quite well. Where would I take this? My entry would not be down here, not even close. My entry is right here. That's my entry. It will not change, right? If you follow what I'm teaching you, it will not change. How many points would you catch on RTY? You guys already know this. You would catch from here, and then you would be stopped out right there at about 6 points. What does that mean in terms of monetary value? Well, I gave you the sheets, so you guys can calculate very easily per one contract on RTY or MRTY, right? The micros. You know how much money you stand to make. So would I have taken this position? Of course I would. Look where we are on our oscillator. That is the entry point. That lines up quite well with my methodology, and this does as well, right? That's a signal. It's pretty clear. It really, really is pretty clear. What about here? Let's look at the risk reward calculator. Let's use that on this example. Let's do the short. Let's take the short position. Let's apply that. If I'm looking for my target might be there, right? How do I know where to set my stop loss? This is going to be predetermined. If you have your OCO orders, it's going to be across the board. But let's just say that I'm setting my stop loss at a static 2-to-1. A 2-to-1 is going to put me approximately there. Did I, in any circumstance, did I come close to that wick? No, I didn't, right? I'm off the 5-minute time frame. It's going to work on any time frame that you choose, provided you are following the principles. Don't focus about the points. How many points, Sage? Is it 5 points on the 5-minute time frame and then 5 points on the 4-hour? No, it's dependent on your risk reward. What is your target? If your target is 20 points away, what does your stop loss need to be? It needs to be 10. What if your risk reward, what if your TP is 200 points away? Probably want to give yourself a little bit of breathing room there, right? You probably want to give yourself about 100 points for a risk reward. Wow, 100 points seems like a lot. Well, you can adjust that as soon as you take the entry. Start thinking about these things in those kinds of light. All right, cool. So now we have a stop loss here. Let's put that. And how are we going to trail this? How are we going to move this position? Are we going to make money on it, right? So we start moving, bam, bam, bam. And then, of course, I'm going to move my stop loss to break even. Obviously, I'm going to do that. But I'm going to let it play out. As soon as I start seeing that the 5 is now coming into the 21 territory, I'm more than likely going to be setting a stop maybe about there. So how many points did I make on this, right? Hopefully you guys are seeing this is more mechanical than it is opinion. Right? I don't have a lot of opinions when I'm looking to day trade. My opinion don't mean nothing. So I'm catching maybe 3.5, maybe 4 points. Is that all sexy? No, but better than a loss, better than break even. Where is this going to shine? This is going to shine when you see those nice little trend days and when you see that nice little setup. Cool. All right, let's do one more example here on YM, and then maybe I'll do a couple stocks, right? This is a recording, so I can't ask for you guys' feedback, which kills me. I love doing these in live sessions, but let's continue here. So where are we going to take YM? Let's do this off the 4-minute time frame, and let's see if anything changes. So off the 4-minute time frame, system is there. It's there. It doesn't matter the time frame. I'm going to take that entry, and where am I going to be stopped out? I'm going to be stopped out maybe on these rogue wicks. Honestly, I would not be stopped out here. I would be stopped out on that. So how many points would I catch on this? Right, you guys know how to use the risk reward calculator now. So from here to here, maybe I'm catching roughly about 55 points. Fine, that's fine. What about if I'm looking to take a short because we're oscillating pretty largely from that drop right here? How many points am I going to catch? Right, from my entry all the way up to where we're tagged on the 21, that looks like a 60-point move to the downside. So you can, as I stated, you can reverse engineer and you can play with this as much as you want. You can backtest. You can take a couple of Pine scripts. You can take a couple of Python code, right? You can literally code something where you're looking at your entries and you're seeing exactly where is the 5 to 21 cross. You can see exactly where they are. This is just code that I've made for myself. And then you can set an alert. Okay, I'm being alerted here. Do I like the setup? Am I going to take the position? Does it even make sense for me to do that? You don't have to just stick around with the 4-minute time frame. You can do this on the 10-minute. You can see exactly where the signals are and what is lining up and what looks good and attractive to you. There's an attractive signal right here on DIA. That's a really attractive signal. My goodness. So in this situation, what is my risk reward? Let's do a couple more examples. I want to exhaust you guys with examples. I'm sorry that it feels like I'm dragging this out, but it is so crucial, dude. It is so crucial to educate people on how they need to think, not just about their winners, but how to manage their losers. Because if you don't know how to manage your losers, it doesn't matter how much money you're making. You can make $10 million. Don't matter if you're not managing your stop losses correctly. All right, so let's check out this trade. This is an absolute banger. How many points would I have caught on this? If I'm using the 10-minute, if I'm entering the 10-minute time frame, you monitor the trade on the 10-minute. So I would have been tagged right about there. So that's a 250-point move to the downside. It's pretty good. You're using the higher time frames, the less signals you're going to take, the less trades you will take. If you're going to use the shorter time frames, you're going to look at a lot more jitter and a lot more noise. I've made that comment already in the beginning part of our trading session. But what you're looking for is supply and demand areas. Are you next to a supply or a demand area? Sometimes you're going to get situations where you're choppy like this. What is going to differentiate the fact that you're in a choppy market and maybe you're looking at a decent sized move either to the up or to the downside? The TTM squeeze. You see how that works? So would I be taking trades right here when we're not really squeezing on the TTM? Probably not. Would I be taking trades when we are oscillating here to the upside? Would I have taken this long trade right here? Never mind that it's pre-market, but yeah, I would have, right? That looks like this is firing. I probably would have taken the trade a little bit later than here, but if it's firing and I'm starting to see that oscillation to the upside, yeah, why not? I'll try it. No problem. Where I really like my trading setups are when we are overbought or oversold, and then we're starting to move momentum in the other direction. So this is a good example right here. Where is the entry on this particular trade? The entry would have been right here, right? At 850, let's say 860. Let's say 860. And where would I have caught this move? How many points would I have caught on it? I can do this all day long, guys. I can do this all day long. About 73 points. Cool. So I'm going to recap once again. I'm going to use just some arbitrary thing. We'll go to NVIDIA. Doesn't matter what stock we're trading. And we're going to go off of, let's do the 5-minute time frame for the last trading session. I believe we sold off, depending on when you watch this video, but we sold off aggressively on NVIDIA. So if I'm using whatever cross that I'm looking for, whatever cross that I think might propagate something, you might say, hey, there's a couple of positions that you are knocking off here. Remember what I said when we started. One of the biggest problems with newer or novice traders is that they're looking for the indicator to tell them exactly what to do, but they're not using that in tandem with other things. So do I have oscillation, or am I pretty much flat right here? It looks like I'm pretty much flat. So I'm using my TTM, and I'm also using my CVD, which I haven't highlighted in this segment of the video, but I'm using that to see, are we in an oversold or overbought condition? What is the CVD telling me here? My zero cross line is there, and I'm trading on the zero cross line here. So if I'm going to take this trade, if I'm going to sell off here on NVIDIA, that is my target area, right? That is my cross. It's at 111. Would I have fired this trade on an open market? Let's just say, hey, Sage, I kind of see a long position right here. You would have been wicked out on that long, right? If you're following the principles that I'm talking about, yeah, you would have been wicked out. That's a rogue wick. It's an annoying one, is what it is. Let's actually do the risk reward calculator on the long position first, because you would have taken this position. More than likely, you're seeing the CVD move up there, and then I'm applying the risk reward calculator, and I'm setting my target. Let's just say I set my target right here. So there might have been a chance where, yeah, I maybe moved up on this trade. I probably would have won. I don't know. I just know that if you're following my stop loss principles, it wouldn't have been a big loss, right? I'm just talking about NVIDIA. I'm not even talking about futures trading. I'm just talking about trading in general. So more than likely, I'm going to be wicked out on that, and it's not going to be a substantial loss because I'm using my OCO orders. Now let's just look at this. Let's use this trade right here, and let's take that cross. I'm losing momentum. I'm looking at market internals, and then I'm saying, okay, I'm just gonna fire on this trade. I maybe lost one or two small trades throughout the day, but this is looking okay because there's a fast cross on that 5 and the 21. Fast meaning that the incline for that 5 overcoming or underpinning in the situation, that 21, it looks like it's pretty steep. Fine, I fire on this trade. Let's not even do it exactly at the cross. Let's say we fire at 111.50. All right, so we're a little bit late to the trade. Had I taken the position at 111.50, how long am I holding on to this position? I'm holding on for roughly about 1.3% move to the downside. Is that a substantial move? No, it's not a substantial move, but it's good enough, right? Apply this to all of your futures trades that you'll be taking. Let's do one more. I'm fired up, guys. I'm absolutely fired up. I know that this is a recording and I want to get your guys' feedback later on, but let's just do this, man. Let's absolutely kill this trading session. Let's see what we have here for the last session on ES. Without cherry picking whatsoever, what do you guys see, right? We see a lot of indecision going on. Bam, boom, 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 boom. You might take a position here. Hey, Sage, that kind of looks like we're oscillating there from the top side. Maybe I would have taken a position, would have been a small loss. Hey, Sage, what if I take this position? This would have been a tiny little gain. What about this? What about that? What about this? What about that? And this is where your discretion comes in. These are trades that are happening at 3, maybe 4 o'clock in the morning. Look at all of the indecision that's happening there, but look at the actual trading session as it is. So let me remove the aftermarket. Let me go here into settings, extended hours. Let's get rid of that here for just a second. Okay, and let's see where we have the signals on ES throughout a regular trading session. Do you see where we're removing a lot of that noise, right? So it is incumbent upon you for you to decide what is supply and what is demand and what to ignore or what maybe not to ignore. In this situation, it looks like you got a pretty good oscillation off that 5-minute time frame. So that entry maybe would have been a little bit more pre-market. Yeah, probably would have been a little bit more pre-market. So you wouldn't have entered perfectly at 57.60. That's not going to happen. But let's say you enter a little bit here because you start seeing, wow, we got a pretty big volume candle, volume delta to the downside. And this looks like it's firing off that high pendulum, now starting to come into an oversold, or crossing the zero line and going into an oversold territory. So you see that your 5 is not really overcoming your 21. So what are you going to do? You're going to take that trade, right? Let's say you enter here. Let's put on a green bar. Let's do that real quick. And then we're going to set a stop loss. So our stop loss is going to be this red bar. Let me change that color real quick. So how am I going to manage this trade? What have I taught you thus far? You're going to be moving that stop loss in accordance to what your 21 is, right? So would you be setting the stop loss here? No, I wouldn't do that. Your stop loss is going to be following along with your 21 EMA. If your candle is starting to come into your 21 EMA, then you have something a little bit more to worry about. A situation very similar to what you see here. But if you are not coming into your 21 EMA, you would have caught this entire trend day. That's what I'm teaching you how to do. I'm literally teaching you how to do this. So where would have you been stopped out? You would have been stopped out here. How much of a move would you have caught to the downside or upside? Don't just think just downside. Think in both directions. How much of this move would you realistically have caught? Let's forget the perfect entry. Let's just say an entry right here. How much of this move would you have caught if you are following along with what I'm teaching you? You probably would have caught a 110-point move to the downside. See how this works? So don't be so quick to fire so many bullets. Don't be so quick to take so many trades, especially if you're not seeing it close to a supply or demand area. Let the technicals, let the indicators show you, hey, maybe we got a setup here. I don't know if it's going to be the perfect setup. I don't know if it's going to be dragged out. I don't know if it's going to be 400 points to the upside or to the downside. I have no clue. But I know what it is I need to look for. Cool. So we talked about stop loss placement, and I'm going to recap this. I'm going to recap this in the next segment, but be very well aware that all that you do on the trading chart, All of it is going to come down to how well you can manage your emotions while you're in the trade. And I've already eliminated a lot of that facet for you. If you're using the 21 EMA or the ATR, you do a little bit of your reverse engineering and decide which one is going to work for you. But I found that the 21 EMA, whether I'm in a long or a short position, works quite well for me. Cool. That's my concluding thoughts for this particular segment on stop losses. Inevitably, we have come to the conclusion of the training session. So let's do a final recap here and see exactly what it is that we learned with a couple of hours that we spent together. First and foremost is the moving average cross. Is it special inherently? No, it's not special. But what makes it special is how you apply your risk reward, where your stop loss needs to be, and how you think about when you're in a trade, what it is that you're actually doing. So we're using the 5 and the 21 just to designate, okay, this might be an interesting entry. But as you sometimes see on the chart, it seems like there's a lot of chop, especially when price action is not moving all that well. What do we use in order to filter out a lot of those false signals, either long or short? We're going to use the TTM. And then on top of that, we want to know the volume delta. How much volume is coming in? And is it buying volume or is it selling volume? So those two indicators are going to help me make a determination on whether or not I want to fire on the signal. On top of that, with the trading system that I taught you, I'm using the VIX and I'm also using the cumulative tick just to be a secondary or tertiary decision-making factor. But all in all, the trigger is going to be initiated by if the 5 or the 21 is going to be crossed. The faster the cross, the more that incline is on the 5 overcoming or underpinning the 21, usually that's where I'm paying the closest amount of attention. Also, I really want to reiterate this point because I think I did quite a bit here to make sure that you understand risks before you do anything, right? Stop loss placements. We talked about that extensively just recently. Also want to consider using the risk reward calculator on all the positions that you take. Another exercise that we discussed, 2 of them that are intertwined with one another, is reverse engineering and also back testing. Reverse engineering, back testing are not going to be the same thing. One is going to be eyeballed and the other one is going to be data driven. Are you going to take all the signals that your back testing is going to quote unquote give you? No, because you're also determining is there supply and demand in the first place. You see that there's a lot of signals, especially after hours. There's a lot of crossing of the wires there. So you have the responsibility as a discretionary trader to be able to filter those out. How do you do that? Well, don't spend all your time on just the 5-minute time frame. Also spend some time on the 1 hour, the 2 hour, the 4 hour, and the daily time frame as well. You will find that with your own backtesting, which I'm finding with my own, that you'll get less signals overall, but they seem a little bit more high quality. And if you're following, that methodology of the 21 EMA, maybe you're not going to be stopped out so unreasonably, and you're going to have a fairly decent target and some profit when you're trading with that methodology. So these are my parting words. If you have anything that was unclear to you, just reach out to us. Let us know. I cannot read your mind. There is no conceivable way that I know so-and-so person is struggling because they don't understand something. Please feel free to reach out. We love getting feedback. I love doing live sessions because I can constantly talk to traders and there's always a conversation that's going on because I'm constantly looking for that feedback. Do you understand? Do you not understand? What is the problem and how are we going to fix the problem? Cool. So feel free to reach out. Hopefully you guys enjoyed the session. I know that it was a long session, but I think you're about 70% of the way there. Whether you're an experienced trader or a novice trader, there's a lot of information to go here and a lot of really good tried true principles that if you apply them correctly, you are a little bit closer to being not just a profitable trader, but a consistent trader as well. Cool. Thank you so much. And we'll see you guys in the next trading session.